It is 9 a.m. live from the NASDAQ market site in New York City. I'm Brad Smith alongside Shauna Smith. This is Yahoo Finance Live. Here are the three things that you need to know to start your morning. Instacart prices its IPO at $30 a share. That's at the top end of the range, raising $660 million in the process. It gives the business a valuation of $9.9 billion. That is a far cry from the $39 billion it commanded back in 2021. It's the second big public debut for the NASDAQ in a week after ARM's listing, but many analysts suggest this one is a better barometer of the health of the overall market.
And the strike against the big three automakers entering its fifth day with a deal still elusive. Now the UAW warning over more action if, quote, serious progress is not made. Union reps is saying that they have received no new offers from GM, Ford, or Stellantis since they laid out their proposals on September 14th. Now, Stellantis says that it has resumed negotiations, citing, quote, constructive discussions. On Friday, 9% of the union's nearly 150,000 members down tools.
And the Fed begins its two-day meeting with the rising price of crude oil emerging as a major headache for the central bank. The global benchmark Brent topping $95 a barrel for the first time since November as the Saudi-Russia plan to curb supplies comes into full effect. The impact on the consumer is being felt. Gas prices hit new 2023 highs Monday as the squeeze on supply translates into higher prices for the refined product.
All right, well, let's focus in on the backdrop today because we've got a couple of big stories out here for you. Instacart's IPO, that's happening right here at the NASDAQ market site. Then we also have the standstill, that is the UAW strike, and the ever-climbing price of oil. Lots to dig in here, Brad. But first, what's sticking out to me is the UAW strike and some of the developments that we heard overnight about the fact that neither side, when it comes to the big three versus the UAW, is backing down. The UAW is now saying that they could potentially expand this strike if they don't see any progress made before Friday. Now, what's standing out to me is what analysts are saying about this potential here in expanding the strike, that they could target some of those more profitable vehicles in terms of the plants that they're targeting, ones that manufacture the F-150, the Chevy Silverado, and the Ram. And that could have a real impact here on these businesses, obviously, but also for investors.
Yeah, and I mean, it's right to point this out, especially with the new kind of fisticuffs or at least Twitter fingers or at least word battle that they're continuing to move forward with here. And we've actually got some commentary on that into our newsroom. Our own executive editor, Brian Sazi, passing along some of the notes from Ford in what they're pushing back on here, and particularly here, some of the points that the UAW is calling out. Ford's saying that, hey, that's not entirely true here. And so as we're kind of coming back to the negotiations, let's keep in mind that our CEO is not earning as much as they say, or perhaps are overvaluing their earnings for the CEO of Ford to be. The profits that they're looking at, the UAW's demands would wipe out billions of dollars of profitability essential to investing in the future. Ford saying that. And on the auto worker wages, on average, Ford UAW workers are today among some of the best paid manufacturing workers in America. That all being said by Ford. So as these negotiations continue on at the same time, while this strike has already been implemented and going into effect, it's a larger question of how far apart the two sides still really are, and if they can actually come a little bit closer, especially on some of the demands that the UAW has put forward here. But we're also going to be watching Instacart today. That is today's morning driver. And today's morning driver, Instacart, big day in the world of IPOs. Everybody knows this. The grocery delivery service is going to make its public debut on the NASDAQ today. On Monday, Instacart priced its shares at $30 each for its initial public offering. That's at the top end of the range that was expected. Instacart previously planning for a range of $26 to $28 a share here. The IPO expecting to raise a total of $660 million, valuing the company at around $10 billion, rough math there. And Instacart certainly has some big shoes to fill after ARM's successful IPO. Okay, so all that said, now you kind of have the table set for what could be a better barometer, as many are looking at Instacart versus ARM. And of course, ARM, for the massive IPO that it was, the largest since we had seen Rivian back in 2021. Instacart perhaps a better child or poster child for the other IPOs that are ready to make their way into the public markets, how they could fare, how they could do, especially in gaining some of that early traction and demand, and then still continuing to grow out the business from there.
Yeah, certainly. Instacart, I almost said Instagram there. Instacart, backed by some of the most well-known VC venture capitalists there in the business. So clearly there's a lot riding on this public debut. You talk about why this is attractive. And I think initially when a lot of people think of Instacart, they think of online grocery delivery. They think of that last mile part of the business. But so much of the importance and really the value here in this business is the access that they have to data.
Right.
And their ad-driven business. So the fact that they have the ads, the fact that they have the software, about a third of their business there speaks to the fact as to why maybe we are seeing higher margins when it comes to Instacart's business relative to some of the competitors out there, and it's profitable.
Yeah.
Now the margins, still something to be a bit wary about, but the fact that it is profitable, that is why it's getting so much attention from the street, and also so much is riding on this, like you said, just about what this could be indicative of when it comes to the broader IPO market and maybe some of the activity that we could see following this debut.
$2.2 billion in gross profit, just to put a number on that for our folks out there that are waiting for this company. Of course, later on, once the book is fully built and once we see it get the go-ahead to go public here, that is going to be the ticker that everybody's going to be keeping an eye on, CART, CART. And
I love that ticker.
That's a good one. We were having a little debate before the show, who has a good ticker, who has bad ticker. We'll save that perhaps for an overflow segment one day. But when you think about the number of U.S. grocery orders that they fulfilled on, 263 million orders fulfilled, and then additionally, the percentage of the grocery market. And here's what's going to be interesting, because going forward from here, as you continue to watch the digital side of the U.S. grocery market continue to be fulfilled, 85% of that right now is Instacart. And so at the end of the day, that's going to be extremely important to see how they continue to service into different markets as well.
Yeah, and it's also going to be critical just in terms of what we're hearing from Instacart with these upcoming quarters here coming up after their public debut, because we know inflationary pressures have been a huge challenge here to the industry, how much you're able to pass along to consumers. So really what this tells us about the overall grocery business and so many maybe potentially of its competitors out there is something investors are going to be keeping an eye on here for months to come. All right, well, stock futures edging a bit lower here this morning as another buzzy IPO, Instacart, and a potential Fed pause seems to be keeping, or if a potential Fed pause seems to be keeping is on the books here. Here for more on this, we want to bring in Caleb Silver, Investopedia Editor-in-Chief. Caleb, good to see you here. So you've got a real pulse of retail traders, individual investors right now, given the fact that there is some speculation that maybe the Fed is going to pause tomorrow. There seems to be some excitement amongst investors in the market for IPOs following what we saw from ARM last week. What's the vibe of individual investors right now?
Yeah, any catalyst will do right now, because we got fear on the left, greed on the right, where our investors kind of stuck in the middle between FOMO, fear of missing out, and FOLA, that fear of losing it all after this good run we've had in the pullback in early August. So you have this sort of unequivocal individual investor, the retail investor, who've actually been pulling money out of the stock market, not adding as much, not much inflows from the retail side, more on the institutional side. We've had that for the past 4 or 5 months. You had inflows going in the first 4 months of the year, and then big outflows in the most recent 4 months of the year. So you have this kind of in between, waiting for the catalyst. Maybe it's the Fed pause, maybe it's successful IPOs, but individual investors not really believing right now.
Yeah, Caleb, I was just about to ask you that. What is the potential catalyst, especially given the fact that AI had seemed to be that catalyst for so long on the FOMO side, but now on the FOLA side, as you put it, fear of losing it all, perhaps some profit taking, initiating here, and now sitting, waiting on the sidelines for that next big pivot?
Yeah, I think a lot of that we might hear tomorrow afternoon when we hear Fed Chair Powell's comments. Are we in for higher for longer, like a lot of people assume? Are we in this place where it looks like those interest rates have done what they need to, those rate hikes have done what they need to do, and interest rates should settle down in 2024? I think that could go a long way. Another successful IPO could go a long way as well. And also this feeling of, I can get 4 or 5% in cash in the bank, and that's where about $5.5 trillion is sitting, or I can take a risk with stocks. And that's where you're seeing this, again, fear on the left, greed on the right, some investors wanting to just sit back and wait and watch this happen, others wanting to take advantage of it.
Okay, let's talk a little bit more about some of the trends that you're seeing on your site, on Investopedia, what people are searching for, maybe some of the things that they're a little bit wary of going forward. What tops that list?
Yeah, we like to look at that because when people are worried about things, they start searching up things to figure out either the best CD rate, that's one of the top searches on the site, best high yield savings, that's been popular all year because you are getting 4 to 5% in the bank. That feels pretty good if you're uncertain about the stock market. Also, personal loans for bad credit. When we see something like that, that worries us a little bit. Are people actually in that much trouble where they're trying to get a loan to get through the next few months because of inflation, because they haven't been able to keep up with these price hikes? But also, you see some riskiness. How to trade 0 days to even options. We know those have been popular this year. Probably keeping the VIX pretty mellow because a lot of people trading the 0 days to even option, and also the money line bet. Football is back in season. A lot of people betting, very busy on FanDuel, DraftKings, etc. People looking to take risks outside of the stock market too. So you have, let me keep my money safe on the one hand. On the other hand, where on the edge can I make some money? Is that in the options market? Is that in the sports betting market? Some promiscuity there, but also some safety and security on the other side.
That's interesting, at least in a mentality perspective, right, Caleb? If you have people that are saying, okay, maybe I'll do a little bit more sports betting, or maybe in tandem, that same frame of mind also transitions over into the options market. Has the options market seen a wave of inflows? And if so, in what direction or sector?
Yeah, we've seen a lot of put bets. The put to call ratio was pretty extreme just a few weeks ago. That settled down a little bit, but it's not as much retail investors, Brad. Remember back in 2021, people were playing the options market. They were short selling. They were going long triple leveraged ETFs. We haven't seen retail investors participate like that in the last, 6 to 7 months. We haven't had that meme stock surge, except on the edge a little bit. And even when we did see a big surge in AMC, or we saw another surge in GameStop or Tupperware, it wasn't the type of inflows or the type of options betting at volume like we saw in 2021. People are being a little bit more tepid about it, and that may be because, hey, we're back to work, we're a little bit busier, but also we got these student loan payment coming back in October. That's going to take about $350 on average out of people's pockets, so not a lot of extra cash to use to play promiscuously in the stock or options market.
So, Caleb, do you think that that's maybe this newer trend that we've seen play out over the last several months? Is that a trend that you see sticking here as you look out to 2024?
Yeah, we see that because we also have something called the anxiety index on Investopedia, which is basically tracking traffic to fear-based terms like recession, like contagion, like depression, like bear market. That's up a little bit, but it's mostly up in the personal finance areas of the anxiety index. People are not that worried about the stock market as much as they are about their personal finances, making sure that their households are secure, making sure that they have enough money to get through the rest of the year to pay their bills. We know housing costs keep going up, food costs keep going up. So there's anxiety, guys, but it's not stock market anxiety like it was back in 2020 or back in some times of real turbulence right now. You see how low the VIX is? We see that sort of in the anxiety index. I'm not too worried about the stock market because I know I can get 4% in the bank. I'm more worried if I have enough money and my household has enough money to get through the next several months and into next year.
Caleb, the previous days of a modern marketer and me love a good word cloud, and you gave us that in your notes. And some of the companies that are most searched for on the platform right now, and Apple is at the center of that word cloud here. And when you think about the number of people that are continuing to look through headlines, whether it be the new iPhone 15 launches or some of the new changes, I guess I gotta go get a new USB-C in any instance where I buy a new iPhone or get into a new contract in the next 12 months or so. All that considered, how are viewers looking at Apple? How are some of the people that are coming to Investopedia and searching looking at Apple right now and evaluating the company?
Great question. So we do a bi-monthly investor sentiment survey through our newsletter readers who are all active investors here in the US. And we ask them, if you could buy one stock and hold one stock for the next 10 years, one stock to rule them all, Brad, what would that be? It was Apple. It's one of the most popular and most widely held stocks on the planet. We know that. And our readers, who are, again, active individual and retail investors, they go with the home cooking. They go with what they know. We know it's the second most widely held stock on the planet next to Microsoft. So they go with what they know. The home cooking is there. But you'll also see a Berkshire Hathaway there. You'll also see an Amazon there. You'll see some very popular stocks. And that's the other thing. Individual investors who are mostly passive investors through 401ks or IRAs or Roth 401ks, they are investing with what they know, and a lot of them have piled into these big stocks, which is why they move the market so much. As goes Apple and Microsoft, so goes the NASDAQ and the S&P 500, as you know.
Caleb Silver, Investopedia Editor-in-Chief. Caleb, always a pleasure to speak with you, get some of the insights. Thanks so much.
Thank you.
Well, as oil extends its rally, hitting a 10-month high, Chevron CEO predicting the tighter market will see prices return to $100 a barrel. With more on what this means for inflation, Yahoo Finance's Ines Ferre is here. Hey, Ines.
Yeah, Brad, and $100 a barrel is now being talked about by more and more analysts. I spoke to one analyst yesterday that told me that, look, yes, $100 a barrel is definitely possible if momentum continues on in this market. But most analysts are then expecting oil to come back down. You also had RBC Capital recently that also talked about the idea of $100 a barrel. That's not their base case. But if momentum keeps going in this market, you will see that. And in fact, Citi's Ed Morse, the head of commodities over at Citi, said that it is possible, yes, $100 a barrel for a short while. But then he says that supply among non-OPEC members is going to outpace demand growth. Now, this all is because of, or a lot of it is because of the supply squeeze that you're seeing in the markets because of the OPEC plus cuts, because of the unilateral cuts from Saudi Arabia when it comes to oil. But at some point, and I did ask this of analysts, at some point, yes, demand destruction does start to kick in. And some analysts are saying that that is at the $95 a barrel price, and you're seeing Brent crude at 95, and at some point also perhaps at $100 a barrel. That's what Andy Lippo of Lippo Oil Associates is telling me. Between 100 and 110, you're going to start to see demand destruction. You're going to start to see people really changing their habits as they see gasoline prices going up. Now, remember, it only takes perhaps an event in order for these oil prices to come down. During the banking crisis, we saw that oil prices were in the 60s. And of course, all bets are off if there's a recession, guys.
So now let's talk a little bit more about gas prices, because I think that's what obviously consumers really care about. Here we are today at $3.88. Is it likely that we're going to head above $4 a gallon?
That is likely if you do see prices at above $100 a barrel. Now, I did speak to Tom Kloza of Opus, and he was saying to me, expect in the next few months to see gasoline prices declining, with the exception of some Western states like California and Nevada. But basically what he's saying is that gasoline futures are at roughly $22 a barrel above WTI crude. So that means that usually it's about $6.71 a barrel to $15 a barrel over WTI. So that means that gasoline futures are really priced for perfection when it comes to demand. Again, if you start to see demand going lower, you are going to see prices going lower. And also, we are going into the winter grade for gasoline, which is cheaper to make. So you are expected to see an ease, at least when it comes to gasoline. Today, the national average is at $3.88. That's a high for 2023 for this year.
Hopefully we'll see some of that relief soon. All right, Ines Ferre, thanks.
Thank you.
We'll keep right here on Yahoo Finance. We've got all your market action ahead live from the NASDAQ market site. We'll be right back.
Make sense out of what's happening in China for us, and are we getting any more clarity that we need on the markets front?
So China is stimulating its economy. A lot of people think they're not, but they clearly are doing it. But it takes time, and I think that China is not in the policy that we did, like a big reopening and trying to stimulate it through free checks and say, let's go and spend a lot of money. Chinese consumers are different. They're also very cautious because what happened during extensive lockdowns, they're wary. But there is some change, and I think that this is about China being very gradual in its approach, knowing it can reach its goal for 5.5% growth. It may not happen this year, however, it may be something for next year.
Welcome back to Yahoo Finance, everyone. I'm Brad Smith with Shauna Smith at the NASDAQ market site in Times Square, New York. We've got just inside of 10 minutes until the opening bell. Let's see what stocks are doing in the pre-market. Yahoo Finance's Jared Blickery tracking it all here for us. Jared, what are you seeing?
Yes, I'm looking at the Wi-Fi Interactive, and we do have S&P 500 futures taking a little bit of a lag south. You can see right there on your screen, we have turned red over the last hour. Not seeing any news in particular that might have precipitated that, but let's take a look at the NASDAQ futures as well. Very similar chart that we're looking at. And finally, here's 10-year T-note futures. This is inverse to yield, so this means yields are heading up. And if we go to those yields and we go to the 10-year T-note, we can see we are right by recent highs. Here's a 3-month chart, and you can see we're up by those highs that we saw in, middle of August. And if you go to a 20-year chart, and that's what you got to go to, that last time that we saw yields about this level was 2007. So some pretty interesting developments there. Also tracking the U.S. dollar. Let's take a look at that, and we can see we are still hanging out by recent highs, but not a whole lot of movement today. Not too worried about that. And let's take a look at some heat maps here for the sector action. We were just talking with Yahoo Finance's Ines Ferre, and energy is by far the leading sector here. That is up 0.8%. You can see yesterday was also up 85 basis points during the day. By the way, the background color is what happened yesterday. The little box there is what is happening overnight. So in the lower corner here, we have XLY, that's consumer discretionary. That is down about 0.33%, followed by tech, and then communication services. So the three sectors that house the mega caps, which we're going to look at right here. Here's the NASDAQ 100. Those are doing the worst today. And indeed, Apple down about 0.2%. Alphabet, Microsoft, each down 0.5%. Meta also down about 0.5%. And I've been tracking some of the differences in the tech sector. Outperformance of software versus outperformance or underperformance of semiconductors, and we're seeing both just broadly weak today. And let me just zone in on a couple more heat maps just in line with the leading sector. We're going to take a look at energy here. ExxonMobil up about 77 basis points. Chevron, that was up yesterday, 43 basis points, up another 1% in the pre-market. So energy just continuing to build on those gains. But if we also take a look at some of the value sectors here, here's financials. That is mixed, guys.
All right, Jared, thanks so much. Stick with us here. We're about 6 minutes until the opening bell. We want to check in on some moving stocks this morning. And first up, we got to take a look at Starbucks because shares are on the move. We got a call out from TD Cowen downgrading this stock from outperform to perform in line here and lowering its price target by about $10 a share. We're looking at the stock off about 1.5% in pre-market trading. Now the team there pointing to weakness out of China and the risk that then poses to same-store sales in the country. And Brad, when you take a look at China, it certainly is a key growth driver for Starbucks. They have about 6,500 locations throughout China. They posted relatively impressive numbers going back to last quarter, that year-over-year growth of 46%. Not a huge surprise given the fact that China was in lockdown just about a year ago. But the fact that we haven't seen this recovery really pick up and what many forecasters had been expecting, companies with a large exposure to China, like Starbucks here, are at risk.
Yeah, spot on. And so even with the difficulties that they're shouting out here with regard to China, in the U.S., they're saying that they still like the playbook here. Most notably, one of the things that they did call out, highlighting a 60+% increase in Starbucks Rewards loyalty members versus pre-COVID-19. The increasing mix of high-margin ice beverages here for all of those. Do they still serve the unicorn Frappuccino?
You should know because you might be Starbucks' one of their most loyal customers.
Well, recently, yes.
Oh, that's a new thing.
Recently,
okay.
Yes. Because of proximity and because of adjusting of my own morning routine. And they actually called out morning routines within this note too. So noteworthy that you brought that up. They said their morning-oriented business tracks changes in payrolls as changes in the number of commuters naturally impact morning routines, like my own. So all of that considered, they still like the U.S. playbook here. We'll see how that continues to nurture itself here. But you really kind of think about this, especially within the U.S., as a kind of pre-pandemic versus post-pandemic kind of drivers of continued growth within the business. And no doubt, some of the adjustment of morning routines pre-pandemic versus post-pandemic now certainly going to be in focus for this company. We're also watching shares of, speaking of whatever your routine is, how you're getting dressed. Stitch Fix. They're not doing good this morning, unfortunately. Sad to report. Shares are down by about 5% right now. The online personal styling company going through a rough patch, announcing its fourth quarter results this week, reporting an over $28 million net loss. It's now winding down its operations in the UK, and the CEO is conducting a business-wide review. Some of that review was already taking place. You heard that within the early commentary that come from the company once they had reported earnings. The CEO, Chief Executive Officer Matt Bayer, had said that our current results are not indicative of what I believe this company can deliver, and I'm committed to realizing the full potential of Stitch Fix, driving long-term profitable growth.
Yeah, we'll see. I think this company has a long way to go, right? When we talk about turning around its business, really getting clients back on board, the fact that we are in this current economic environment right now, people are strapped for cash. They don't have much extra within their budgets. They're forced to make some of these tough decisions, and something like Stitch Fix, unfortunately, is exposed to that. So they're saying in their earnings release here that their clients are still being cautious. But Matt Bayer, you mentioned the new CEO there at the helm. He certainly has a proven track record in retail. He's coming from Macy's. He's only been at the company for a couple of months, so he's already made some executive changes. He's announced job cuts. He did some of the strategic moves that you were just mentioning, like closing the UK business or exploring options there, focusing on the US styling business. But I think they have a long way to go in order to get investors back on board with a company like this. This is a stock that has been under a tremendous amount of pressure for some time. Lots of people wondering what exactly that growth potential looks like and what they need to do really to execute on that.
I would never tout myself as the most fashionable person out there.
Fashionable,
However,
actually.
well, I mean, look, I did go to one New York Fashion Week event, so I guess I get looped in with the people. But at the end of the day, I think the clients are saying it all right now, and the clients are speaking through how much they are churning off of this service right now. Active clients of 3.297 million. That's a decrease of about 498,000 or 13% year over year. So when you've got this type of attrition of clients who are leaving the service, no doubt it's a question of, all right, what are the fashion decisions, what's being served up, and do the clients see enough value of continuing to purchase in and having that monthly purchase, even as they may be considering, okay, where can I cut some expenses that I may have on a daily basis.
And that's up against some stiff competition. You talk about Rent the Runway, but then many of these legacy department stores like Bloomingdale's, Nordstrom, they offer their own stylist options, right? So you really have to go out there, market it well, sell your product right now, and really distinguish it from the rest. And it's proving to be a little bit of a tough task for Stitch Fix, at least right now. All right, let's move on to the healthcare sector. And CVS is on the move this morning. I'll call it here from Evercore, upgrading the stock to outperform, raising its price target by $2 a share to $83 a share. We're looking at gains of just about 0.2%. Evercore is saying that CVS's operational issues are getting resolved. They also think that it is attractively valued. This is a stock that's been under pressure since the start of the year. Brad, what stuck out to me, though, in this note from Evercore was what they had to say about Medicare Advantage. And they think, at least Evercore thinks, that CVS is likely to regain that 4-star rating. And I was digging into that just a little bit there. It certainly has an impact on the members, the number of people that are enrolled in this option. They're saying if they can get back to that 4-star status, that's going to be a huge growth opportunity for CVS.
And what they're expecting, they're modeling half of the about $800 million to $1 billion in bonus payments returning as well as part of that Medicare Advantage plan. So we'll see exactly where that kind of gets priced in here on the day. We're taking a look at the opening bell on Wall Street. Let's do a quick check of the markets, sponsored by Tasty Trade as we strike 9:30 a.m. Eastern time here. We've got a quick look at some of the major averages. There in the bottom corner of your screen, you're taking a look at Instacart, ringing the opening bell here at the NASDAQ. And of course, that on the day of their IPO. CART is the ticker that we're going to be tracking as we move on throughout the rest of today's trading session. Let me toss things on over to Jared with a look at what we're tracking at the open.
You bet, Brad. I was talking about weakness in the mega caps in the pre-market. You can see everything to the left half of the screen here is red. The worst performers, Amazon down about 1.1%, Microsoft down 0.75%. Not a disaster. You're not seeing any dark red here, but nevertheless, a little bit of an ominous start to the day. Let's take a look at the Dow as well. A little more green here. We're seeing some green in energy names like Chevron, JP Morgan, Financial, Verizon, Telecom, but in some of the high beta sectors, we're definitely seeing a little bit of a trail off here. And here's a look, and this is very similar to what we were just looking at in the pre-market. The mega cap sectors down here, all of those underperforming. Energy, by far and away, the biggest performer, reminiscent of last year when it was one of the only performers, followed by materials and financials. Those are just barely in the green right there. And if we take a look at some of our leaders, we have actually Bitcoin. Bito is at the top left. So Little love for Bitcoin as it flirts with 27,000. We'll have to see, make sure it holds 25,000, but until it clears 30, we don't really have much to talk about. You'll see in the lower part here, meme stocks, those are down 2.5%. That's an ETF that tracks those. And it looks like we have some weakness in the transport, innovation, chip stocks. So a lot of those high beta sectors, and here are the semiconductors, some of those fall in it, not doing too well today. NVIDIA down 0.6%. And in software, we got a couple of green squares here, but nothing really huge. CrowdStrike up about 13 basis points. I want to chart some of the trending tickers today on our site. Here is Block. Here's a year-to-date chart. Square, the CEO of Square Payments, has left, and that we can see that the stock is at the year-to-date lows. You take a look at a max chart and you can see the fallout it's had from its pandemic highs, not quite down to its ultimate lows, but definitely little cause for concern there. Nikola Corporation getting a little bit of a bump. You wouldn't know it by this chart, but you take a look at the year to date, you can see a bit of an uptick right here. I believe they were able to acquire a new leader in one of their divisions. And then Target down to year-to-date lows. It is also at these lows, but on no news in particular that I can see. But in general, I'm seeing the retail trade just flag a little bit today, guys.
All right, Jared, thanks so much for laying out the scene here at the Open. We're going to continue to track all of those moves and much more here on the day. One of those other moves that we're tracking for you, Moderna and Pfizer. Pfizer shares, well, in focus right now as they are moving higher, but Moderna doing the opposite. Moderna lower right now by about 0.4%. So some fractional moves, but in different direction. This week, the finance chief of Pfizer forecasting weaker demand for COVID shots this year. Pfizer is predicting a roughly 24% COVID vaccination rate in the U.S. this year. That's less than half of the vaccination rate against the flu. You also had something similar come out from Moderna as well. So a larger question, and for many of these companies, they could have seen this. They should have seen this coming, especially as for the vaccination campaigns that rolled out very early on and the number of inoculations that were administered at everywhere from a CVS to a Walgreens, and Moderna and Pfizer being some of the early beneficiaries of that. There was a larger question of, okay, so what would that tail cycle look like as you started to see a wind down in the kind of push for, but also the receipt of vaccinations, even if that was on a booster basis going forward.
Yeah, and we certainly know that this is so important to their businesses, especially though for Moderna. And that's really why we saw such a reaction in their stock yesterday following this announcement here, I guess you can call it, from Pfizer's CFO. But they're working to diversify their business. They've been doing that for quite some time, but they're still heavily reliant on COVID shots, at least for now, when you talk about their business in 2023, even into early 2024. So any sort of expectation of weaker than expected demand obviously is going to have a real impact on Moderna's shares specifically. And we saw Moderna get hit pretty hard yesterday. The biggest one-day decline that we've seen since the start of the year, closed down yesterday off about 9%, off another 1% or so this morning. Now essentially flat, though, on the day. So we'll see what exactly those numbers look like. 24%, like you just said, forecast that Pfizer is expecting Americans will get updated COVID shots. A bit better than what we saw last time. Only about 17% got the booster that was released last fall as of May. So a bit of an uptick there on a year-over-year basis, but certainly well below what Moderna, what Pfizer, and what many investors have been hoping to see.
Yeah, something worth continuing to track, especially as we consider the amount of people that might look at and hear any news about the newest variant and decide, okay, just let me get boosted before the winter comes around.
It doesn't hurt to be safe. Yeah. All right, guys, we'll keep right here on Yahoo Finance. We've got all your markets action ahead live from the NASDAQ market site. We'll be right back.
Goldman Sachs analysts and top executives from across the technology, media, and telecoms landscape are gathered in San Francisco for its annual Communacopia and Technology Conference.
Nextdoor is doing some pretty cool things on the AI front with our assistant and also with Vitality. For us, it actually starts to unleash unique data. We are the local knowledge graph, so I think the value of what we do starts to really shine forth. We're the only platform where you're finding out what's going on around you locally in real time. So with that data, we can do things like on the platform, help a neighbor compose a post in a way that is more engaging. So the assistant or the AI actually does that for you.
There's lots of interesting discussion we can have around AI. So we announced just this morning, Zoom AI Companion, which is our answer to how generative AI is going to be included in our platform. And there's all kinds of really cool features that come with that for our paid subscribers. There are things like Chat Compose, if you're in a chat thread and you want to be able to respond to that. There are things like meeting summaries, which after the fact help categorize and capture not only what happened in the meeting, but also the true sentiment.
I think any creative would admit that AI is transformative to how they think about and how they concept new ideas. So I think it's going to be very exciting. It's still early innings, and we got to figure out how to do it right.
There's a lot of hype in our industry. I think this may be underhyped. I think it impacts things at so many levels. It impacts how we interact with computers and how they seem personal. It generates how art and media is created. It's really a breakthrough in computer science, and it impacts not only the products, but it impacts how software is created.
There certainly needs to be a lot of debate about AI and journalism. 57% of newsroom jobs in the United States have been lost. We're facing another wave, in this case a tsunami potentially of job losses because of the impact of AI. And these are not just jobs lost, but it's insight lost. It's important that all media companies understand the impact, but it's incumbent on the big AI players to understand their impact.
We launched Intuit Assist. And Intuit Assist is really a personalized, intelligent assistant in your pocket. It's also powered by AI-driven human experts so that when you are getting assistance from Intuit Assist, if you ever need to talk to an expert, no matter what it is that you're doing, you're able to do that. So there's always a gateway to help.
AI is going to change this whole industry completely. And so we're thinking a lot about how do we use AI to match people a lot better and to support the conversations that are happening. I think conversational AI is also a big opportunity because people do produce all these messages. So helping them craft those messages, make it easier to communicate, I think is something people will really appreciate as well.
Welcome back, everyone. We're live with you from the NASDAQ market site. You're watching Yahoo Finance. All eyes are on the Federal Reserve ahead of its policy decision. Jerome Powell will announce whether the Fed will decide to raise interest rates or hold them steady on Wednesday. More economists are feeling pretty good about the economy and are expecting a pause in rate hikes here. Goldman Sachs chief economist Jan Hatzius sees a pause in rate hikes tomorrow amid a, quote, soft landing summer. And Luke Tilley, Wilmington Trust chief economist, says that the Fed will not end up raising rates again this year thanks to cooling inflation data. Of course, the elephant in the room, at least as of right now, and as the meeting begins now, Shauna, is oil and what pressure that is anticipated to potentially put on the inflationary, the broader trend that has been locked into this point.
Yeah, certainly. We heard that from Deutsche Bank in their new note out this morning, talking about those fresh signs of inflationary pressures, what exactly that means for the Fed. And Deutsche Bank saying that investors are moving to price in that interest rates are going to remain higher for longer into 2024. So the fact that we have seen such a big jump in the price of crude, in the price of energy, really across the board, that's obviously a real headwind to the Fed's fight against inflation. JP Morgan also out saying that they do expect the Fed to leave rates on hold at this meeting this week, but maintain that hawkish bias. So when it comes to that, both in the statement, but also in the dot plot, continuing to project a further tightening this year. So the Fed needs to be careful walking that line. We saw Fed Chair Jay Powell do that the last several conferences. He wants to get across the point that, yes, they are making progress. Yes,
right.
The policy that they have in place is working, but they still have more room to go. Their work is not over yet. We clearly see that from the latest CPI numbers, from the latest PPI numbers. Exactly how he balances that message is going to be so crucial here for the markets.
And what's particularly interesting is the services spending as well as the housing side of the equation that the Fed is going to be considering here. And people will remember that from some of the most recent FOMC minutes that we got, several participants, they had commented about the significant disinflationary pressures yet to become apparent in the prices of core services, excluding housing. So all of these things considered, yeah, it's been a hot services spending summer, and everybody going from Beyonce to a Taylor Swift concert or even just going out to watch Barbie. One way or another, there is still some hot spending in the services part of the economy. It's just a larger question of where for in the price moderation that we're going to continue to see on the products and the goods producing side, how that could potentially still be one of the broader headwinds that the Fed is going to be tracking in this near-term period of
It's
time.
hard to say no to Swift.
I mean,
and Barbie.
Well, and there's going to be a movie now.
Yeah, and there's
You've got
going
the
to be a
Taylor
movie
Swift-
now, so people might be out there spending a little bit more to go see that in theaters at AMC. All right, let's talk about a trending stock here this morning, and that is AutoZone. Cruising past earnings expectations. The company reported a beat on both the top and bottom lines during its fiscal fourth quarter, but despite beating the street's expectations, take a look at the share price right now. Now, it's still early trading, but you're looking at losses of just about 2.5%. Trading lower after the company's lower than expected growth in its domestic commercial business. Here to talk about that and more, we want to bring in Seth Basham. He's Wedbush Securities Managing Director of Equity Research. Seth, it's good to see you again. So let's first start off with the results that we just got here from AutoZone. Like I said, a beat on both the top and bottom line. Sales up about 6.4% from a year ago. What's your first take of these results?
Yeah, certainly the top and bottom line looked better than expected. However, as you called out, the domestic same-store sales were a little bit weaker than expected, particularly in that commercial segment. Domestic overall same-store sales were up 1.7%. Street was looking for 2.4%. And commercial same-store sales in the U.S., we estimate to be up in the 2 to 3% range versus expectations in the 5 to 6% range. So that's a disappointment. And this is the second quarter in a row that we've seen disappointment for that commercial business, which is one of the key growth drivers for AutoZone. So our initial take is that they still have work to do to improve the trends in that commercial business. The overall business, however, is relatively healthy compared to the rest of the hardlines retail segment.
Okay, so you're saying that they still have some work to do, but you also named AutoZone your top pick in auto parts retail. So kind of put those two together, put those two frames of mind together for us, Seth.
Yeah, certainly. So within auto parts retail, this company has more exposure to the retail segment than any of the others that I follow. So about 75% of their sales are to that retail consumer, and that retail consumer spending on auto parts should be better trending than it has for the last 2 years or so because of the pressures that they're experiencing with inflation and running through their pandemic era savings. So we expect that to be a positive for the retail segment of the industry and therefore be better for AutoZone. Now, if we look at their overall comparable store sales compared to their peers, we're talking about trends that are a little bit better than the likes of Advanced Auto Parts and GPC's Napa Auto Parts division. However, O'Reilly Auto Parts is the clear standout with stronger trends driven primarily by their commercial strength, but to some degree in their domestic retail business as well. So comparing it to O'Reilly, we like the positioning of the company and we like the valuation discount to O'Reilly.
Seth, we have the UAW strike ongoing right now within this sector. How does this then position AutoZone? Does it actually position them pretty well given the fact that, hey, maybe people aren't going to go out and buy new cars if we do see prices rise as a result?
Yeah, to a certain extent, it might lead consumers to hold on to their cars a little bit longer, do more maintenance on their cars. But I think it's a bigger boost for used cars retailers. So there'll be demand shifting from new car purchases to used car purchases, particularly late model used car purchases. And that'll be a boost for retailers such as CarMax.
Yeah, okay, so all of these things considered, Seth, when we think about the number of people that are just looking across the portfolio of, it's a nice way to put it, portfolio of purchases that you're making or just a basket of purchases that you're making, have we seen any kind of shrinkage in the number of items that they are purchasing, even if they are going into one of the auto parts purchasing experiences right now?
Yeah, overall, the number of items, the unit sales at the auto parts retailers have been down for the last year or two here, and that's because of severe strength during the pandemic. So you're facing tough comparisons. The drivers of comparable store sales growth for these companies have been primarily in the form of price-driven inflation, and we've seen slowing growth in price-driven inflation over the last few quarters, probably down to the low single-digit range at this point in time. So we're expecting unit sales to start picking up some slack here against easier comparisons because of those economic pressures that we talked about.
Seth, rising gas prices, it's something we've been talking about now for quite some time. Is that an overhang on the stock?
Certainly is. Rising gas prices oftentimes leave consumers to drive less, and miles driven is one of the key metrics of auto parts repairs. So if we see that trend continue, it would be a negative.
And what if people just said, you know what, I can't get the premium stuff, so I'm just going to kind of downgrade, get some regular. That means that your car might not take it on as well over time. Does that mean that it's a potential kind of not all out bullish signal, but is that something that the auto parts retailers could benefit from?
Potentially. We've never seen that play out directly in the data, but that could be an incremental boost for sure. But one key thing for these auto parts retailers is that now half of the parts or more that they sell, particularly AutoZone, are private label parts. So these DIY consumers who fix cars themselves are looking for the lowest priced parts, and they go to a retailer like AutoZone to meet that need. And those parts still carry very high margins.
Hey, Seth, real quick, you were also out with a note this week on Carvana, upgrading it to neutral. Now, you've been pretty critical of the stock for quite some time. What do you see as maybe this short-term catalyst, at least for now?
Yeah, in the near term, the company is benefiting from some industry trends and also benefiting from some strong sales of loans that they previously originated that were sitting on their balance sheet. So those two things are leading to strength in their EBITDA, and we think that's going to continue here in the third quarter that they're going to print in a month or so, as well as their fourth quarter. But as we look into 2024 and 2025, as the company tries to pivot back to higher growth, we think that EBITDA is going to come under pressure.
All right, Seth, maybe I was just outing myself earlier, and maybe I'm the only person that downgrades the grade of their gas when things get a little too high. I don't know. I thought everybody was doing it, but I've downgraded myself all the way to an MTA pass at this point. Seth Basham, who is the Wedbush Securities Managing Director of Equity Research. Seth, appreciate the time this morning.
Thank you.
Thanks. All your markets action straight ahead, live from the NASDAQ market site in Times Square. Stay tuned. You're watching Yahoo Finance. You have tons of great economic analysis, markets analysis as well, but you're also training for the New York Marathon. What is your number one tip for all the runners out there that are perhaps trying to get their miles in and see you when they're running throughout the 5 boroughs here in New York later?
Yeah. Well, first of all, you have to be really determined to do it. You know, do not give up, because as much as it can be very painful and exhausting, you know, when you get through that, you feel great. So just keep going. And keep training with consistency. You know, you can't slack off, so to speak. You got to do it every other day, I would say, or every 2 days, and really put in the work. You'll make it.
Welcome back, everyone. The United Auto Workers Union says that they will expand their strike to additional auto plants if progress isn't made by Friday. The historic strike has made headlines over the past few days, and at first glance, the fight is simply over better pay and benefits for auto workers. But Yahoo Finance's Rick Newman thinks it's worth keeping eyes on EVs, and that on your radar. A shift that could completely change the auto landscape as workers know it. Rick joins us now with more here. Rick, take it away.
Yeah, electric vehicles are a major factor in the dispute between the labor union UAW and the three Detroit automakers for a couple of reasons. Obviously, much of the automotive industry is shifting away from gas-powered cars to electric vehicles, and EVs actually require fewer workers to build because there are fewer moving parts, about 30% fewer workers, and the UAW is clearly paying attention to that. Another factor is that since batteries are such a big component of EVs, that is a big chunk of the manufacturing for electric vehicles. And many of the battery plants that automakers are building in that battery belt that stretches from the upper Midwest all the way down to the South, many of those are joint ventures with other companies, including some foreign companies that are not unionized. So the UAW sees two things happening: the need for workers declining, and a bigger chunk of auto manufacturing going over to non-unionized workers. And I think that is where this demand for a 32-hour work week is coming from on the UAW side. So they're saying, okay, we realize that EVs will require fewer workers, but instead of actually employing fewer workers, why don't you employ the same number of workers and just cut back on hours so we can all earn a full week's paycheck with just 4 days of work per week. No idea how that's going to shake out, but it is really shaping these negotiations. And I don't think it's a question of whether EVs will remain available for consumers. I think it's a question of whether the three Detroit automakers will be competitive in the market for EVs, because they are going to face higher costs than Tesla and other companies that are not building these with unionized workers.
And Rick, how problematic could this potentially be for President Biden, right? We talk about the fact that he obviously has been very pro-union. Now you have the UAW pushing back on some of his policies. What does that then mean for President Biden heading into the election year?
He's facing conflicting priorities here. So Biden, clearly a huge fan and a champion of electric vehicles. He signed the big green energy bill last year that has literally billions, hundreds of billions of dollars in subsidies for green energy, including electric vehicles. So he wants that transition to happen as fast as possible. To some extent, the unionized workers are standing in the way of that agenda. Now, Biden, of course, also calls himself the most pro-union president in American history. And he has come out with a sort of a tepid amount of support for the striking workers. There are some Democrats who are saying Biden needs to go to a picket line. He needs to show up in UAW land and express solidarity with the striking workers by hanging out with them for a little bit, doing some photo ops and stuff like that. I'm not sure that would be the best move because he also is relying on the three companies, Stellantis, Ford, and General Motors, to be the ones who push his green energy agenda forward, including the union jobs that he says are essential to the green energy transition. So I think Biden is probably hoping that both sides can solve this problem without him having to get more deeply involved. I'm just not sure that's realistic.
Certainly has put him in a pretty tough spot. All right, Rick, thanks.
See you guys.
We'll keep right here on Yahoo Finance. You've got all your market action ahead live from the NASDAQ market site. We'll be right back.
Best piece of career advice that you've ever got?
Ask questions and sometimes wait to answer when you're asked questions.
You have tons of great economic analysis, markets analysis as well, but you're also training for the New York Marathon. What is your number one tip for all the runners out there that are perhaps trying to get their miles in and see you when they're running throughout the 5 boroughs here in New York later?
Yeah. Well, first of all, you have to be really determined to do it. Do not give up, because as much as it can be very painful and exhausting, when you get through that, you feel great. So just keep going. And keep training with consistency. You can't slack off, so to speak. You got to do it every other day, I would say, or every 2 days, and really put in the work. You'll make it.
Welcome to back to Yahoo Finance Live. I'm Shauna Smith alongside Brad Smith at the NASDAQ market site in New York City. We are about 30 minutes into the trading day. Let's take a look at how things are shaping up right now. We're looking at pressure across the board with all 3 of the major averages still in negative territory. Now stocks are down on this busy Tuesday with investors. Well, they're awaiting Instacart's big debut after shares priced at $30 a share. Investors are also anticipating a pause in rate hikes to be announced by Fed Chair Jay Powell at tomorrow's Fed meeting.
Taking a look at some individual names that we're watching this morning. NIO, the stock is on the move and lower right now by about 11%. The Chinese EV maker announcing a $1 billion convertible bond offering. They say the proceeds will be used to repurchase a portion of existing debt securities. This comes after 3 consecutive quarters of losses for the company.
And shares of Block are also on the move this morning after announcing that the head of the company's Square payments platform, Alyssa Henry, is stepping down on October 2nd. Now, CEO Jack Dorsey, he's going to be taking over Henry's responsibilities. Investors reacted negatively to the news initially, and we're still looking at losses here down just about 3%. But JP Morgan analysts are saying that maybe some of these worries are overblown.
That's right. And in some vehicle news, we're also watching shares of Volkswagen. It's been a tough year for the auto giant as it battles a slowing German economy, concerns over succession, and the fallout from a possible EU-China trade war. The European Commission launched an investigation last week into whether to impose punitive tariffs on Chinese EV imports. While switching gears here, over the last few months, there have been no shortage of reports speculating over the future of Goldman Sachs CEO David Solomon. But it seems there might be a big disconnect between media coverage of the man and the views of the board. Mike Mayo, Wells Fargo Securities head of large cap bank research, joins us to discuss. So Mike, just walk us through some of perhaps the discrepancies between what's taking place in the board here versus what's actually the story being told to the public.
Well, I've been one of those people watching these stories and wondering what's going on. So I requested to have a meeting with the lead director of the board of directors that oversees the CEO and the rest of the management team. And I had that meeting yesterday. The lead director's nickname is Bio. And I had met with Bio before 7 years ago. And I said, what's the state of the CEO, his status? And he said, why are you asking that question? Look at our results, look at our execution, look at our strategy. So on that basis, based on the cold hard facts, they have had best-in-class book value growth the last 5 years, and they've had best-in-class market share gains. So that was the start of it, but then what about those intangible soft factors that's written about in the press? So I followed up with questions on that, like what about your reputation? And he said the reputation is actually fine.
Mike, what about morale? Because that's something that we've been hearing a lot about, the fact that many of the partners have been unhappy, to say the least, with some of the actions that Solomon has taken.
That was another one of my questions. The CEO is on record as saying that the partner turnover is no different than normal. And the lead director reaffirmed what the CEO had previously said. They did acknowledge that they've made some mistakes at management level and at the board level. They said that the consumer lending strategy, they should have not done that the way they did it. They said the disposal of on-balance sheet investments should have happened faster, and they should have expanded their third-party alternative investments faster. And when it came to departures, they said, yes, again, this is the lead director of the board of directors, yes, they've lost some talent that they did not want to lose, and they've also lost some people who just disagreed with the new revised strategy. Having said that, and this all goes to reputation, he said the reputation with clients remains strong, and the lead director of the board visits with the clients. The reputation with employees based on their internal surveys, I don't have access to that, but he says he analyzes that, and those are fine. And as it relates to the broader reputation, the pipeline of talent, Goldman Sachs had over 1 million applications last year for people applying to jobs. So it looks like the reputation from the perspective of the lead director of Goldman Sachs, who has a lot more information than I do, the cold hard facts are good, and based on him, the soft factors are also fine. So despite the news stories, and I've been commenting on many of these, it looks, based on my meeting with the lead director, the board of directors of Goldman Sachs yesterday, this puts a fork in the issue about the CEO issue, or what turns out to be a non-issue. And I know people have been talking in terms of days or months, but really the question is a matter of years. And if he can execute on his medium-term plan to improve returns to the mid-single digits and improve the returns in wealth and asset management up to the mid-single digits, that's been depressed. That's 1/3 of the business. And the other 2/3 of the business has been crushing it. That's global banking and markets.
Yeah, and Mike, so all of that considered, are there leading contenders waiting in the wings that the board has on their radar, even if this kind of changeover at the helm would be years out from now, as you were mentioning a moment ago, based on those discussions?
You know, another data point in the discussion, and it hit me after the meeting, I said, what are the board's priorities? And the first priority is execution, execution, execution. And that's what they're super focused on. And we talked about some other topics, and then further down the list was AI, actually, is a big topic, and tech, and improving efficiency. And succession was really the fourth item that came up in terms of a board priority, and it only came up in the sense that Goldman Sachs has identified the next 200 leaders beyond the 30 or so management committee that they might want to develop over the years. But that was the only context succession came up. It was listed as the fourth priority of the board after some, major topics before that.
Is that a red flag, Mike? Is that something that maybe investors should be a little worried about?
No, Goldman has a history of cultivating talent. And it was interesting, back to that partner leaving discussion. And the lead director of Goldman Sachs said, you know what? Sometimes we'll actually encourage partners to leave. And we may lose a couple years of their expertise, but that allows us to have 10 really good years of the next up-and-coming partner. So I thought that was an interesting perspective. And my sense is they ease partners out the door. So some of the departures were kind of desired by Goldman Sachs. So no, I think they have a deep bench. And you see the Goldman Sachs diaspora with ex-Goldman partners and others leading all sorts of businesses and being leaders in government and business. So that's not, there's other red flags we can talk about, and certainly risk and cyber and the ability to execute on their new plan. But I don't think the talent, the bench at Goldman Sachs is an issue.
Of the prioritization, of the ability to execute on that new plan that you're talking about, Mike, does that change in one direction or another very vastly your own kind of not just evaluation of the company, but evaluation of their outlook, evaluation of how they can actually meet some of those targets?
Absolutely. I think the question now is, look, I was very critical, and I still have, concerns that can they actually execute? But here's a company that has increased book value by 50% over the last 5 years, and they trade close to tangible book value. So implicit in that statement is investors have concerns, and I think the concerns really are about their ability to execute and improve the return on equity higher. And one of the root causes is the asset and wealth management business. It eats up 30% of capital. The returns are mid-single digits. They need to dispose of a lot of their on-balance sheet investments. They said they're going to do that, but what's their ability to do so without taking outsized losses? And when will the capital market cycle return? But if things come together and they continue to gain share and the capital market cycle turns and they dispose of some of their on-balance sheet investments, then their returns should be higher. And I got the sense from my discussion yesterday with the lead director that they're not satisfied with the 10% or 11% return, and they're going to push very hard. And so long as the plan is, executed they're on that path over the next few years, then this discussion about CEO staying or going is irrelevant, I think, in the mind of the lead director of the board, and he represents the board.
Mike, just lastly, while we have you, where does it sound like Goldman is prioritizing the consumer, and particularly some of their efforts within consumer banking that have come to light over the past few years?
They're waiting to take some actions with their GreenSky. They've sold loans in Marcus. Certainly, they've gathered deposits, 120, 130 billion or so of deposits. That's helpful. But the prioritization of consumer is way down the list. When they talk about their two main businesses, 2/3 and 1/3, consumer's not part of that. So it's really about that's going on the back shelf in terms of their priorities, even though they're still gathering deposits.
All right, Mike Mayo, always great to get your perspective on here. Thanks so much for joining us this morning. Mike Mayo, Wells Fargo Securities analyst there. All right, well, it is day 2 of a busy week in housing data. Building permits and housing completions were both up on a monthly basis in August, but housing starts, well, they took a dip. Construction on new homes falling to the lowest level since 2020, a sign that higher mortgage rates are a growing challenge to the sector. For more on this, we want to bring in Jessica Lotz, National Association of Realtors Deputy Chief Economist and Vice President of Research. Jessica, it's good to see you. So let's talk about some of the pressures that we're seeing in housing. Clearly, higher mortgage rates above 7%, proving to be a real challenge for the sector. Any relief in sight?
I mean, I think that we all hope that there is going to be relief in sight, but it's really difficult right now. It's difficult for consumers, but it's difficult for builders to bring products to market. I think seeing that housing permits were actually up could be some indication that even builders are hoping that interest rates will go down in the next few months, because there's about a 2-month lag between permits and starts.
It's interesting because we had heard from the NAHB yesterday, the chairman, Alicia Huey, saying that the 2-month decline in builder sentiment coincides with when mortgage rates jumped above 7% and significantly eroded buyer purchasing power here. So for buyers who are continuing to evaluate this market, Jessica, what silver lining could they possibly take away from even this week's Fed meeting and any commentary that they hear about policy decisions from this point?
Yeah, it's really hard right now. I mean, I will say for a silver lining, if you're a consumer out there and you're trying to purchase a home, I mean, at least we're not looking at last year's really strong demand, that frenetic activity that was going on in the real estate market, where we actually had 5.5 offers for every existing home that was listed. If you're a consumer right now, you have the opportunity to actually tour a home. You are buying it at a higher interest rate. You may have the opportunity to refinance that in the future. So that could be the silver lining. As we expect that interest rates will drop, that's going to mean more demand in the housing market for this limited inventory. I wish that housing starts had gone up, because we really truly need that demand. We need that supply right now.
Jessica, what level do you think rates need to fall to in order to see a little bit more inventory, in order to move some of those potential sellers to actually list their house?
Well, when we saw that rates went into the 6s, we actually saw that housing starts went up. So it's possible that builders would actually feel more comfortable if if the interest rates went down, that housing starts would go up at that range. It's also very possible that consumers themselves will feel more comfortable in that 6% range. Once you're above 7, where we have been for the last several weeks, I think it makes it very difficult for a consumer to imagine jumping into the home buying market, even among homeowners who are locked into lower interest rates as well.
Jessica, what is the likelihood that builders would begin reducing prices in order to spur some of that demand?
Yeah, and that's something that we're already seeing. Is we're seeing that they were having rate buy downs. They were definitely having incentives to bring into these new housing products. And so consumers were actually finding that quite attractive. And we saw that new home sales were actually up. So it is possible that some builders are still going to offer those types of incentives to bring consumers into the market, especially if they've already dug in and that ground is already gone. They're going to want to bring a consumer into that house.
Jessica, are you seeing a little bit of a different picture when you look to various parts of the country? Because yes, the Northeast, there's not a heck of a lot of homes for sale, but we have seen a little bit more activity when you look to the South and when you look to the Midwest.
Yeah, absolutely. And those have always been pretty attractive places to build. Traditionally, we do see more building in the South. That traditionally has been a place to do so. In the Midwest, I would say that also has been very attractive for consumers in recent years as we look at affordability. And a lot of people have relocated into those Sunbelt areas. So building there, not surprising as we look at where it is attractive to move to right now. A lot of people are attracted not just to favorable job markets, good weather, but also where are my friends and family? Where's my support system, especially if I don't have to be close to a workplace right now.
That's why I'm trying to get all my friends to move to Seattle with me, Jessica. Maybe one day.
You can't leave us here.
Yeah, I won't actually. But at the end of the day, Jessica, when you think about how this is also continuing to perhaps overflow into the renters market right now, is there any persistence that we're seeing from the housing market starting to, and not just starting to, but continuing to put pressure on renting prices?
Well, as a native Seattleite, I will say that I will be first to move there. But yes, as we look at multifamily, that's a big concern because we do see that home building is down there. What I would say too is that when we look at last summer, we know that there were multiple offer situations when it comes to existing home sales, but there were for rental units. And that's a big concern, as we know that there's a lot of young adults who are trying to have their own place, not to have a roommate, not to live with family. They want to find a rental unit. An affordable rental unit is very hard to find today.
All right, let's perhaps do this next interview from Elliott Bay out there sometime, Jessica. much more environmentally friendly, perhaps some crisp air. We'll get all the foliage, I guess, at this time of the year start to come out. Jessica, great to have you on here with us today. Appreciate it.
Thank you.
Absolutely. All your markets action ahead live from the NASDAQ market site. Stay tuned. You're watching Yahoo Finance.
We're here at the NASDAQ in New York City. Let's do a quick check of the markets. This is sponsored by Tasty Trade. Just about 45 minutes into today's trading action, you're still looking at pressure across the board with the Dow off just over 180 points. The S&P trading off by just about 0.5%. You're also looking at the NASDAQ under pressure with some of those larger cap tech names trading to the downside. In terms of the sector action so far today, consumer discretionary, that's off just over 1%, as well as technology, followed by industrials. We've got energy and healthcare bucking that downward trend. Well, summer has flown by, hasn't it? Fall is slowly approaching, and before you know it, we're going to be talking about the holidays. They are going to be here, and despite inflationary pressures, you can expect that consumers are still going to be spending this holiday season. Now, according to a new MasterCard Spending Pulse report, holiday retail sales in the U.S., they're going to rise 3.7% this year from a year ago. For more on the state of the consumer, what we should expect for holiday spending, we want to bring in Michelle Meyer, U.S. Chief Economist at the MasterCard Economics Institute. Michelle, it's good to see you. So we're expecting a bit of an uptick here in spending. How much of that, though, is because of inflation?
Well, of course, inflation filters into the numbers. We are looking at overall nominal spending with a 3.7% projection. But what's important is that inflation is always part of the figures. And the reality is that this year, it's actually less meaningful than it was last year or the year prior. So when you think about the overall inflationary environment today, we have seen a moderation. We've seen a number of categories actually see price reductions. Last year, we were in what was an accelerating inflation environment through the summer, some slippage into the fall and into the winter, but it was much higher than normal. Now we're in a more normal inflationary environment for many categories.
Michelle, what are expected to be some of the largest, perhaps, categories that are the catalysts for this year over year, at least, increase in spending?
Sure. So there's a number of things that stand out to us. One has to do with how people are consuming food. And you don't typically think about that when you think about holiday spend, but it's really important because people are out and about during the holiday season and increasingly enjoying going to restaurants, going to theater, going to experience their spending along with their family and their friends. So certainly it's about, this festive feasting that we think will continue into the holiday season. The other one that stands out that's super interesting, it has to do with electronic spending. We have seen what we think is some acceleration in spending at electronic stores. And we think that could be partly the replacement cycle kicking in, maybe new technology that's helping to gear consumers up to spend again on electronics.
Michelle, when we take a look at how much energy prices have jumped, right? We have the price of gas national average right around $3.88, the highest level that we've seen since the start of the year. How big of a threat is that potentially to some of the holiday spending that you're anticipating?
Well, look, we're obviously monitoring that very closely. We have seen prices of the pump pick up along with the increase in oil prices over the last few months. But relative to this time last year, we're still in a better environment. So to me, it's about the trajectory into the end of the year around gas prices and energy prices. And that will have quite meaningful effects on how consumers are willing and able to spend. And it, of course, impacts his overall consumer sentiment as well. So absolutely need to be mindful about that into the end of the year.
The spend level per household, where have you kind of estimated that will come in at?
Well, we don't have outright numbers to share, unfortunately. We're focusing instead on the overall growth rates, which again, about 3.7% for retail sales ex autos on a year-over-year basis, slightly above what you would consider a normalized pace of growth for a holiday spending season.
Michelle, given your background, obviously, as an economist, there's a lot of focus, obviously, you can say, on what we're going to hear from Fed Chair Jerome Powell tomorrow afternoon. When we talk about future policy, the impact that is obviously going to have on consumers if we have this higher for longer interest rate environment, how big of a risk is that when we talk about that last mile getting inflation to the Fed's 2% target, but trying to do that without putting the economy into a recession?
Well, it's been this balancing act that the Federal Reserve has had to do this whole time. And I think it's important to think about the Fed and their policy in stages. When they first started hiking interest rates, they were doing so carefully, trying to understand what the appropriate level of interest rates were with this imbalance in the economy between supply and demand. And then there was this period of catching up, really rapid hikes in order to bring monetary policy to a more appropriate rate. And the path that we're in now, the point in this hiking cycle we're in now, is much more about data dependence, about calibrating policy in order to ensure that we will be able to see this landing in the economy where you can get to a more steady and desired pace of growth and inflation. So I think that's a message that we'll hear from Fed Chair Powell tomorrow, that they are carefully watching the data. They're trying to figure out how monetary policy is transmitting into the economy. And they're looking at the parts of the economy that are going going to be most sensitive to interest rates, whether that's the housing market, as you were just talking about previously with your guest, or it's thinking about overall balance sheets or corporates. There's many different areas for which monetary policy transmits. And to me, that's what the Federal Reserve is going to be very, very focused on. And I think that's what we'll hear tomorrow.
Michelle, Best Buy and Target are trying to get my money right now. And I sensed that this morning when they put out their releases for early holiday deals, giving these sneak peeks, trying to give us a sense of how many more employees would be getting hired in order to make sure that my order is fulfilled and I have a great customer experience. How much does it actually move the needle when some of these promotional deals and the announcements of these come forward, especially in an environment where the consumer might not be breaking, but they are certainly bending and looking for more promotions?
So, Brad, I think that's a great anecdote and a great story, because it's certainly what we are seeing in terms of consumer behavior right now is that consumers have regained a lot of the power. There's a lot more choice out there, especially relative to the last 2 seasons where there was a high degree of uncertainty as to whether or not there would be enough inventory or shipping would be delayed. In this environment, I think consumers feel like they have, the ability to navigate very, very well. And they're really quite focused around promotions. We saw that in the last season. It was a bit of a fits and starts holiday season where consumers concentrated their spending around moments in time, particularly around those promotions from the extended Black Friday period and then the last rush right before the holidays. So I think that is going to be telling of what we'll see this time around, where consumers are going to be, choosing when and how and where they spend. They're going to be looking for promotions, and I think a lot of retailers are going to be competing for that market share.
Yes, much of my spending is typically concentrated on December 24th here. Procrastinators Anonymous. Michelle Meyer, MasterCard Economics Institute U.S. Chief Economist, joining us here. Michelle, always a pleasure to speak with you.
Thank you for having me.
Thanks. You got it. After last month's FOMC meeting, Chair Powell stressed the Fed will take a data-dependent approach when considering future hikes. The data has been less than ideal in 2 key areas of the market as of late. First, housing market tighter than ever, home construction falling 11.3% in August to the lowest level since 2020, highlighting the declining housing affordability. And oil prices have rallied in recent days, with robust energy prices driving up inflation during August. So what's the Fed's biggest hurdle, housing or oil? Joining us now to help put some clarity around that question, we've got Kyle Campbell, American banker, staff writer. So Kyle, when we think about what's going to maintain the majority of the conversation as it pertains to their 2-day meeting for the FOMC, what's it going to be? Is it going to be housing or oil?
That's a great question. And certainly both are drawing up a lot of attention right now. But I'm going to say housing is going to be the bigger concern because oil prices are, they're volatile. It's a commodity that's set globally. And I think you're probably going to hear Chair Powell say something to that effect tomorrow during tomorrow's press conference. So I think they're going to kind of look past that and look at the housing side of things, because that's something that is, that's sticky. That's going to be there for a while. And it's complicated because you've got, still strong underlying demand for housing, of course, because it's an essential need. But this limited supply, and it's going to be a problem for a while, and one that I think the Fed is, just going to have to sort of, grit its teeth and push forward through, because they don't really have a lot of levers to hit the actual, the real issue, which is supply.
So, Kyle, what do you think that then tells us about the Fed's future policy when you look ahead to the end of the year and into 2024? Lots of speculation about the fact that we're going to be in this higher for longer environment now, maybe for even longer than initially forecasters have been anticipating. Deutsche Bank coming out with a note this morning saying just that. What are you expecting to see from the Fed, not necessarily from this meeting, but when you look out into next year?
Yeah, I think they're going to be, they intend to hold policy, their monetary policy, high for a while. But I don't know that they're necessarily going to be able to do that, because I think that there's always some sort of hiccup along the way that is going to, trigger some kind of a response. But what is going to be interesting is what happens once they do start to bring down, start to bring that interest rate down, especially on the housing side of things, because you have this really big pent up demand for housing. You have all these folks who, are locked into a pretty low rate right now, who are holding on to their home maybe longer than they want to. Maybe they want to sort of move and retire. Maybe they want to just sort of upgrade, but they can't because they don't want to take on that higher interest rate payment. Once you start to see rates come down even a little bit, I think you're going to see a surge in interest from buyers, and then that's going to sort of drive prices up even more. So how they sort of manage that part of the equation is going to be interesting. But I think it also speaks to sort of even further into the future, how the Fed is going to navigate sort of critical moments in the economy, and are they actually ever going to lower their interest rate as low as they did in 2020 and sort of post GFC, where you go to sort of that lower bound. And you create these sort of issues where it just, it becomes, you have this sort of stagnation in the housing market, and you create these affordability issues. So that's what I'm going to be interested in, sort of very long term.
Kyle, even if we were to see a cut as early as the first quarter next year, as some economists have been telling us here on this show, would that signal the cycle of cuts, or would that just be kind of one-offs where the Fed is introducing some type of policy, but we could see that policy moderate or oscillate?
Yeah, I mean, I think it would be difficult for them to cut and then raise again afterward, because that sends very mixed messages. So I think if there was to be some sort of a cut, things would have to, the trajectory would have to move in that direction, either continuing to move down or sort of maybe holding at that slightly lower rate for a while. But certainly I wouldn't expect there to be sort of a quick change in sort of moving upward again. Essentially, a cut signals that they're going to be looking to move down whenever possible and holding, when it's not possible.
We'll wait to see what we hear from Powell tomorrow afternoon. Kyle Campbell, great to have you, staff writer at American Banker.
Thanks for having me.
Got all your markets action ahead live from the NASDAQ market site. Stay tuned. You're watching Yahoo Finance.
You have tons of great economic analysis, markets analysis as well, but you're also training for the New York Marathon. What is your number one tip for all the runners out there that are perhaps trying to get their miles in and see you when they're running throughout the 5 boroughs here in New York later?
Yeah. Well, first of all, you have to be really determined to do it. Do not give up, because as much as it can be very painful and exhausting, when you get through that, you feel great. So just keep going. And keep training with consistency. You can't slack off, so to speak. You got to do it every other day, I would say, or every 2 days, and really put in the work. You'll make it.
go. Welcome back to Yahoo Finance Live. So we're in the Chelsea Piers area, near off the water here in Manhattan. Brunswick, the largest maker of pleasure boats in the world, having their media day here. But we're on a special boat right now. Dave Folks, CEO of Brunswick, joins me now. So Dave, a lot of things going on, a lot of boats on display, but we're on a special boat here. It's autonomous. Tell me about it.
It is. It's a Boston Whaler. It's one of our best brands, premium brands, 405 Conquest, but has a lot of technology on board this one. And as you mentioned, a development system that allows you to dock the boat autonomously, which is familiar technology for cars, but new technology for boats. So we're very excited about it.
Yeah, so basically, from my understanding, it can actually auto dock it for you. Right now, we're using a technology called Skyhook, where it's using the motors and GPS, right, to keep us in place.
Yeah, frequently you want to hold a boat in position. Because of waves and wind and current, it takes quite a bit of effort. So the Skyhook system takes all of that away, all of that effort away. It uses a GPS system and maneuvers the engines to hold the boat exactly in position, not just in the same position, but the same orientation as well. So it takes a lot of stress out of that particular maneuver.
So Brunswick, we're not just here for the fun on the water. Brunswick had its investor day yesterday, talking about the future of the brand. A big part of that is electrification, and not just electric boats, which we'll get into, but also stuff like house power. So talk to me about that exactly.
Yeah, you know, we can use electrification for propulsion on smaller boats, but on a big boat like this that requires quite a lot of power, it's much tougher to do. But there's another engine on a boat that not many people know about called the generator, and that powers all of the systems other than propulsion. So all of the air conditioning systems, all of the environmental control systems, the entertainment systems on the boat, the electronics. And in this boat, instead of having a diesel-powered generator, we have a large capacity lithium-ion battery pack, about 20 or so kilowatt hours, that powers everything on the boat. And you can see right now it's very quiet, there's no vibration, no fumes, no emissions. And this particular pack has another 8 hours of power left. And when the power runs down, you switch on the main propulsion engines and it charges it back up again. So much more efficient and environmentally friendly.
You know, you mentioned these smaller boats that will be electric powered. We saw there's a Veer boat out here that's got an electric motor at the Avator series of electric outboard motors. We got a taste of that in Wisconsin recently, which we'll see that coming up soon. But talk to me about the kind of the business opportunity that electrification offers. I know it's very early innings here, but what does that mean to you exactly?
It is early innings, but everybody sees electrification all around them, particularly in passenger vehicles. And it's coming into marine is a bit more of a challenging environment for electrification. Partly that's obvious, but partly boats are much more weight sensitive for the batteries. They require more power, but we can electrify small boats. We've just introduced a whole series of new small electric outboards, as you said, called Avator, designed to power small boats. We only launched them in April. We've already sold 2,000, which is a big number for marine space. They're popular in the US, but particularly in Europe, where there are a lot of regulated lakes that don't allow combustion engines anymore. So this is an important market for us to get into. And as the technology evolves, we'll move electrification into bigger and bigger products.
You mentioned that it's not just what the customer wants, it's also what governments want. So that's kind of a big mover in that space. Talking about the future of boating here, you know, we see there's a man riding around in an electric foil of some sort.
Yes,
Looks like he's from the future. It's really cool stuff, but I know that you guys are getting into this sort of very recreational type of few hours here and there, hop on the board, have fun. Is that the future? Is it e-fuels? Is it that? What are we talking about here?
Yeah, we see a multi-fuel future for boats. Boats are a bit more like aircraft or commercial vehicles. You can't electrify everything. That doesn't mean you can't make it more efficient and more sustainable. You can certainly make our engines more efficient, and we're very interested in things like e-fuels and alternative fuels for some of the bigger boats. But part of our job, we're the biggest company in the industry, is to just get people on the water in a sustainable way. So we have multiple brands with multiple price points to get people out on the water. This is one of our bigger boats. We make very small boats, including the electric ones. And running around us, as you said right now, is an e-foil, which is like a surfboard, except it's got a foiling element underneath it, and it's electrically powered. So a lot of people like wake sports right now or windsurfing. This is an electrified alternative. This guy going around us can go for 3 or 4 hours on that thing. It is super fun, very exciting, and yet another way to get people out on the water.
So, you know, boating is, I think a $50 billion industry in the U.S., recreational boating. How big of a sliver is that e-foil that's
You know, that market is still pretty nascent. We're excited because we have one of the best brands in the market. It's probably about a $100 million market right now, but we think there's a lot of opportunity for growth in that market. A lot of people are not even exposed to this so far. If you saw one, you'd be, taken aback. As soon as that gets more exposure, I would expect the market to grow pretty quickly.
So, talking about stuff like that e-foil technology and what people are looking into, you have your sort of pulse on the consumer. The spending on boats is a very discretionary purchase here, but people love it, but it's not, you don't necessarily need it. But you offer a number of products across a number of price points, including that e-foil and this lovely Boston Whaler. What is the consumer telling you, the boating consumer telling you these days? Are things the same, getting better, or getting worse?
Well, you'd have to say that consumers everywhere are under more pressure at the moment than they were 3 or 4 years ago. Certainly the cumulative impact of inflation and interest rates, if you're financing a product like this, that certainly has an impact. But we survey boaters a lot and understand what they're thinking. 80% of boaters say boating is part of their lifestyle. They'll always be in it, they'll never change. More than 90% of boaters say that they will be in boating at least for the next 5 years. So we have a very resilient consumer base. Of course, some of them are under pressure, and we can help with that. We can offer some discounts or promotions, maybe to help them into the product, which we certainly will do. But fundamentally, it is a great lifestyle product and a very resilient marketplace.
So, real quick, what's your favorite boat that you have out here? Real quick. Is it
this is my favorite boat that I have out there. It's a beautiful boat, multi-purpose boat. The Boston Whaler brand is such a strong brand, and it really attracts great technology, I think. Boat this size with this capability, you can just load it up with that value-add technology and bring it to market in a way that people really appreciate.
Well, I'm going to take the boat for a bigger spin as we check out the Manhattan waters here by Yahoo Finance Live. We're live here at the Chelsea Piers Marina with David Foulkes in Brunswick. We'll be back after this break.
We're back with you live from the NASDAQ market site in New York City. Now, Iveda is a surveillance tech company focused on protecting communities with the help of artificial intelligence. When you take a look at what they are doing, their AI technology works with surveillance systems to help locate, track, and isolate threats in homes, in schools, and in hospitals. Now, the company also recently announcing plans to scale the development of smart cities across Egypt, as well as Europe, the Middle East, and Africa regions. Joining us now with more is the founder and CEO of Iveda. We have David Lee. David, it's good to see you here. So before we dive into, I guess, exactly where the technology can be used, tell us a little bit more about, one, how the technology works and what exactly you're able to detect with it.
Thank you, Shauna. Technology, just to describe it down to earth and grassroots, it's very simple. It leverages existing infrastructure, meaning if you have an existing camera, if you have an existing security sensor or alerting mechanism, the AI on the back end comes in and helps make sense of what these alerts used to mean. Before, when a camera had motion, that's all it was. And sensors in the past, I always related to old school Radio Shack sensors. You got an alert, big wow, you don't know what's going on. What the AI is doing is it's detecting now, ahead of time, everything that might be of interest to you, all in real time. And it makes sense of it, and it lets you know and focus on what really matters, not just, hey, I've got an alert.
How are you kind of marketing, selling the features that Iveda has? Is it surveillance or is it cybersecurity? And where are you seeing some of the users, the end users, really kind of latch on to the services that you do offer?
Great question. The marketing of the technology really is reliance on existing end users that have a greater need for systems they've already invested in. So leveraging partners throughout the world, we partner with service providers. These are your local telecoms, wireless companies, security providers, et cetera. And these are the guys that touch you and I in our homes. You know, they come in, install our security systems, they install our TVs, our cameras. Now they're leveraging Iveda AI's technology to enhance existing systems and infrastructure. So that's how we're growing globally, and it's easy for us to actually install and deploy because it's just that simple. It just sits right next to what you have now and enhances the application and services.
David, how do you best protect the data that you have access to as a result here of your technology, and I guess limit some of the risk associated with that, because people we know, obviously, and rightfully so, are very worried about some of their privacy concerns?
John, a great question. I get that all the time. The good news is this. Iveda AI and other AI technology, I'm going to try to speak in favor of all here, is that cybersecurity is highly dependent on the local infrastructure, meaning if you're a school, you have your IT department. If you're a government agency, you have your IT department. What's great about our technology, we reside on premise with you. So we are behind everything that you're already protecting. So the data that we manage on your behalf, it's sitting in your house.
David, when we think of the success rate for what you've already been able to detect and through the services that you offer, I mean, some of the different areas where you serve into and applications of your technology are into things like campus security, or into things like school safety and security as well. What is the success rate that you've been able to see within those realms?
Well, based on just our experience alone, you know, we are seeing everything from out of country and in country, everything from municipal deployments to more local, let's say your 7-Elevens and school campuses. The good news is we are seeing great success. I don't want to answer it by percentages, but it's a high percentage, and it's in the high 90s. Why is that? It's the human experience. When we come in and help a customer, it is that customer that says, wow, we could have never done this because of lack of staff, lack of labor, lack of people, and the human can only do so much. And that's the greatest thing about AI, is that it enhances and acts as a force multiplier to what you and I are already able to do. And frankly, that's the benefit, and that's the so-called efficiency.
David, is this something that can be used in airports as well? I think that would be a great use case for a technology like this.
Oh, yeah. Yeah, Sean, it's of course, airports have the most advanced infrastructure in place. You know, I'm talking about cameras, access control, elevators, everything involved in power and energy. This is immediately applicable to airports. And as a matter of fact, in Taoyuan International Airport in Taipei, Taiwan, Iveda is already there. And we didn't just come in and bring heavy artillery. We came in and use and leverage existing infrastructure, their cameras, their power meters, their sensors they already have. And it's the AI application behind the scenes that starts communicating, making sense of it all, and then alerting on the anomalies that take place, where humans in the past had to watch with our eyes, had to hear and make out what the alerts mean. So yeah, definitely, wonderful application.
David, we're taking a look at the stock as well here, and I mean it's been a rough go over the past kind of year. If you can look at the delisting notice that the company received, where have you kind of shifted gears? Where have you acknowledged that something needs to change more drastically and more quickly to make sure that investors are seeing the true appreciation of everything that should be factored into the share price?
You know, Ryan, this is the tough part of being a public company. And yes, we believe and we understand that for shareholders are looking for the strength in the stock price. But what's happening now is the company is staying fully focused on executing within the operation. Our global customers, we have to deliver. And we're so busy and excitingly delivering right now in all regions of the world. And where our partners around the world are excited for us and with us. And that's the type of energy, passion, and you know, pace that our shareholders don't always get to see. So thank you for asking that question. We're maintaining our trajectory. And yes, I understand as a public company, it's going to happen. Revenue is going to be showing. When it shows is based on when the government and municipalities and our enterprise customers take action with us. So it's inevitable that it's going to be a great success. So I'm excitedly, I'm busy working every morning. My team is happy. Yeah, man, it's good times. And yes, as a public company, it's that double-edged sword, you know, you got to face it, but I'm keeping focused, the company's focused, and we're looking forward to great success.
Yeah, the type of chop that can be seen during volatile moments as a publicly traded company, not for the weak stomachs out there. David Lee, Iveda founder and CEO. David, thanks so much for taking the time here today. Appreciate it.
Thank you for having us. Thank you for having me.
Certainly. Everyone, we've got all your markets action straight ahead, live from the NASDAQ market site in Times Square. Stay tuned. You're watching Yahoo Finance.
What story are investors not paying close enough attention to right now?
I think it's water, and we have a real scarcity of water, and it's only going to get worse as temperatures rise. Fresh water, water for industrial projects, water for municipalities, that's going to be a big issue. It's not going to be a big issue this year, potentially, but going forward, I think that's one thing investors need to be paying attention to.
Elon Musk has suggested charging all users a monthly fee to use the social media platform formerly known as Twitter, now named X. He made the remarks during a live stream event on X with Israeli Prime Minister Benjamin Netanyahu. The leader questioned Musk about anti-Semitism and hate speech here. Now, some of the details of this live stream conversation, Musk basically saying that the company was moving to a small monthly payment for use here, and for the charges that they've already started to roll out for some people who opt into Twitter Blue, or just Twitter verification, Twitter checkmark, whatever it's called here these days. I think this is a company that is largely trying to offset what it's losing in advertiser dollars with just trying to make sure that they can charge however many users are willing to stay on the site and pay for it. But again, this was a site that many for a decade basically had come to know as a free service. Larger question of how many people will churn out of it if they are forced to pay.
Yeah, certainly. I think it would be a much smaller user base. I don't think that would come as a surprise really to many or really to any out there. But I do think we also have to remind everyone that Musk has floated a number of ideas that he hasn't necessarily followed through on. So this might have just been top of mind, might have come out of his mouth, and now day two he's saying, hey, I actually don't know if that is a good idea. I will say, though, it does make a little bit of sense in this environment right now. We know across the board the ad market has been under an extreme amount of pressure. Musk recently saying that their Twitter, or X, I should say, excuse me, their ad revenue down 60% here in the US. So they need to do something. They need to raise their revenue, doing everything they can. Not a heck of a lot of social media platforms are on a subscription-only basis.
Right.
We know many have barely started a subscription option tier amid this very tough, challenging ad market. But a subscription-only, you think, would really be able to, or would potentially dwindle those number of users?
It's to battle the bots. And just one key quote here, it's the only way that he can think of to combat vast armies of bots, because a bot costs a fraction of a penny. So if they have to pay even a few cents more, then that no doubt could perhaps impact the amount of bots and decrease that and perhaps drive a better user experience.
Yeah, that's actually a pretty good argument for that. All right, let's do a quick check of the markets here about an hour and a half into the trading day. And you're looking at losses across the board. Jared Blickery and Diane King Hall have you for the next hour. See you tomorrow.
Welcome to Yahoo Finance. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Diane King Hall with Jared Blickery. Here's what we're watching. Instacart prices its IPO at $30 a share. That's the top end of the range, raising $660 million in the process. It gives the business a valuation of $9.9 billion. We will be across the opening trade. And the strike against the big three automakers enters its fifth day. With the deal still elusive, the UAW warning over more action if, quote, serious progress isn't made. Plus, the Fed begins its two-day meeting with the rising price of crude oil emerging as a major headache for the central bank. Global benchmark Brent topping $95 a barrel for the first time since November.
But first, let's get a quick check on the markets, and we can see we are not in rally mode. We have a mixed market there. It looks like Dow down about 0.2%, NASDAQ down 0.87 basis points, been mired in the red all day. And just taking a quick look at the Treasury market, we can see the 10-year T-note yield is up 1 basis point to 4.33%. And taking a quick look at the 30-year as well, that is up to 4.4%, Diane.
Wow. And investors are eagerly awaiting Instacart's highly anticipated public debut today. The grocery delivery service could play a pivotal role for the IPO market after the success of ARM's listing last week. Yahoo Finance's Josh Schaefer has the details. Josh, take it away.
Yeah, Diane. So what we have here, you see a nice little boxing ring, right? We've got ARM versus Instacart, if you will, in some ways. And the big thing that stands out, obviously, is these big valuation differences. You're looking at $54.5 billion to just shy of $10 billion, the valuations before these companies went public. And important to point those out because some of the IPO experts I talked to think that Instacart is going to be a better indicator of where we are in the IPO rebuild coming back, that market becoming more active than, say, ARM. A couple key reasons for that, maybe to go along with this boxing theme, if you will. ARM has bigger reach. ARM is in about 99% of smartphones. When you take a look at Instacart, Instacart is still building out its business and looking to acquire customers in its core grocery delivery business. They noted in that S1, only 12% of people that buy groceries right now buy them online. So you still have Instacart building out versus ARM, a much more established company and a company we should mention that had previously been public. When you take a look at the IPO market in general and what we've seen, you see a big difference that ARM already made here. Valuations in Q3 already coming about in line with Q2, if not above Q2, coming off that big decline we've seen since 2021. So not more deals yet this quarter necessarily, but the value is coming up. And a lot of that was ARM driven. Now we're going to see how Instacart, a smaller company, reacts when it starts trading maybe later this hour, guys.
Like that boxing ring. Thank you for that, Josh Schaefer. And the excitement around Instacart's IPO has some people wondering if it could be too good to be true. Joining us now with our insight is Yahoo Finance reporter Brooke DePalma. Brooke.
Good morning, Jared. Good morning, Diane. I mean, as Taylor Swift says, it's been a long time coming when it comes to Instacart going public, but many wondering whether or not the headwinds that the consumer economy is experiencing right now is going to impact shares of Instacart. Many experts that I spoke to expect near-term shares of Instacart to pop nearly 10 to 15% in the public debut, but ultimately, these experts are also warning that there are odds, some trepidations upcoming around the consumer economy, like that auto strike, like the government shutdown, like gas prices, and ultimately inflation still taking a toll on consumers' wallets. Now, as I just mentioned, inflation when it comes to grocery prices, which of course is Instacart's big business here, inflation continues to tick higher year over year. In the latest CPI report, we saw inflation up 3%. That's compared to the previous month increase of 3.6%. So while we're seeing some deceleration, it's still up year over year. In addition to that, shares of DoorDash coming under pressure today and ultimately down nearly 60% since their IPO. Uber Eats also under pressure around this IPO. Many ultimately concerned about the near-term growth in grocery delivery. And in addition to that, margins are better for these competitors, Uber Eats as well as DoorDash. One expert that I spoke to said ultimately what we're looking at here is if you order $100 worth of bacon and eggs, Instacart gets anywhere between $8 and $9. But DoorDash and Uber Eats business, who is largely restaurants, those then come to a higher margin, a higher revenue for DoorDash and Uber Eats at the end of the day. So lots of concerns, but also lots of excitement around this IPO
and
today.
it begs the question of, are the margins enough when it comes to Instacart? And to your point, the valuation of Instacart when you compare it to a DoorDash or an Uber Eats, will it be enough to have a tailwind past being the hot IPO, the popular girl for the day? We shall see. I don't have a Taylor Swift song. Sorry, I'm not enough of a Swiftie. I'm disappointing a former producer who's a big Swiftie and a current one here. I'm sorry. All right, let's talk. We'll switch gears to another beverage. We'll stick with food and beverage, but switch to a beverage giant, Starbucks. The company announcing today the eagerly anticipated opening of its China Coffee Innovation Park. Now, Brooke, you've been keeping an eye on the company's investment in China. So what can you tell us about this?
Yeah, well, shares under pressure this morning after the company made a big announcements in China. They've been planning the launch of this center, this manufacturing and distribution center for nearly 2 years now, and shares falling a bit in early trading here. They're ultimately saying that they're betting big on China. They recently announced a new co-chief executive officer that comes in, Molly, her name is. She comes in October 2nd, and the company really betting big here with this China Coffee Innovation Park that is opening today on Tuesday. But ultimately, this has once again been a long time coming for China's Starbucks ramp up in China. They plan to open 9,000 stores in total. They currently have nearly 6,500. But many experts that I spoke to both say it's an opportunity, but there are challenges as well that Starbucks faces as they make a play into China. One of those challenges include China headwinds are likely to get stronger rather than weaker as consumers move past the impact of those COVID-19 lockdowns. And Leland Miller, who's a friend of the show, also said there is no immunity to U.S.-China geopolitical tensions, despite Starbucks really trying to outweigh the odds here. But some opportunities here is the potential to franchise. We know that former CEO Howard Schultz was against franchising. They do own their stores there. Previously, they had licensed stores there. And so perhaps with Howard Schultz stepping down from the board last week, there could be a potential opportunity to franchise the business there, like we saw with other fast food giants. But ultimately, at the end of the day, the opportunity here is that Belinda Wong, who is the chairwoman there for Starbucks Chinese business, is just a potential coffee market that is yet to be tapped in China. We know that Chinese consumers only drink about 12 cups per year,
which is wild.
And so big white space there.
And yet 6,500 stores, simply amazing. Another 15,000, 16,000 in the U.S. Thank you for that, Brooke DePalma. All right, the big event of the week is Wednesday's FOMC meeting. That is the Fed. Investors are expecting the Fed to pause monetary tightening. According to the CME FedWatch tool, investors are pricing in a 70% chance that Powell holds steady on rates through the end of the year before making cuts. And our next guest agrees that we may be at the end of the tightening cycle. So joining us now is Marvin Lowe, the State Street Senior Global Macro Strategist. Thank you for joining us here today. Just give us our top-level view, kind of in broad strokes, what you might expect, what we might expect from the Fed and Jerome Powell tomorrow.
Yeah, for sure. I think the market is correct in expecting the Fed to skip this meeting, not necessarily pause the hiking cycle. Some of the commentators just before me talked about inflation. They talked about consumer strength, and I think that's going to require the Fed to maintain its vigilance. Ultimately, they'll keep what we say is optionality for another hike before they're done with the tightening process. And then the focus becomes on if there's a different signal with regard to the pace of cuts next year. I think that at this point, the inflation story is not well packaged. I don't think the Fed is comfortable that they're going to get to 2%. So while I don't expect any changes to their view for 2023, which at this point includes one more hike before we get to the peak rate, the terminal rate, if you will, they might signal that they're not going to cut as aggressively going into next year. So this higher for longer message is probably where we're starting to see concerns around interest rates being volatile, being higher, if you will, over the last couple of days, and a little bit of the volatility within the equity markets as of late.
So, Marvin, let me ask you to expand a little bit on the expectations for 2024, especially when you keep in mind where the dot plot was at the last meeting. And that was before we had new inflation prints come in, showing inflation was heating back up after it showed some cooling. So what would you say is where your expectations stands in terms of so the projection based on the last dot plot was we would see a cut maybe in spring of 2024, right? What's the expectation for your view now? What are you preparing for?
Yeah, so I think the dot plot was signaling that we were going to have an aggressive second half of 2024 with regard to cuts. It really needs to tie into what their economic projections are. So one of the glaring, I think, concerns that the Fed has is that the employment market remains tighter than they expect. They expect the unemployment rate to get to 4.5% by the end of next year. And given how strong the jobs market has been, even though we've seen a slowing of it, they might not feel comfortable with that number. If they actually lower their unemployment number, does it mean that growth is a little bit better because there are more people that are working? Does it mean that inflation is a little bit hotter? That ultimately would form the basis for potentially thinking that it needs to hold rates higher for longer, even though what we've heard from Chair Powell as well as some of the other speakers is that they think that rates are restrictive already at this point. They think that the current interest rate is one where the economy should slow. It's just we have a lot of post-pandemic things that we're still working through. Some of them might be structural. There are less people that are working, and others might just take time. The amount of savings that is still in the economy, which equates to liquidity, which has to be drawn down in order for policy to really reflect what they're trying to do.
And Marvin, nevertheless, we have the 10-year rate just screaming north, 4.34%, right at the highs over the last 15 years. You'd have to go back to the global financial crisis. Is the 10-year done? We had Jamie Dimon coming out last week and saying he could see it at 5.5%.
You know what? I'm not in that camp. I do think that we could potentially have a little bit more creep up in rates, but not to the degree where we're talking about a 5 handle. The market is volatile. It's trading around each of these headlines. Every data point is live, as the Fed likes to say. It's looking at every data point. So, can it push up to 4.5%? Yes. What we're seeing is that our real money investors that we talk to, there's demand for yields at these levels. They like these levels. So I think ultimately that contains it. Although, if you're looking to play yields going back into the 3%, if you will, which would be certainly positive for your bond portfolios, I think it's premature to really think that that's the case at this point.
And Marvin, I want to dial back to kind of where we started our conversation and where expectations are, right? So the majority, over 60%, are expecting the Fed to skip at this meeting. But last week, that number was 90%, right? 95, 98%, something like that. But there have been surprises before. Generally, Powell signals what's coming. Are you prepared for a surprise?
You know what? I would be very surprised if there was a surprise. The two surprises would be for them to say that they were done hiking. I don't think the CPI number and the strong GDP expectations that we have for the third quarter, kind of seeing how data is coming in, will allow them to say that. The other surprise would be for them to hike and signal that they're going to be more hikes. That would be probably the most challenging for the market. It would certainly push, the view that the Fed funds rate could get to 6%. I think that the signaling that they've had, both from Jackson Hole as well as the more hawkish members of the committee, are willing to see how things evolve. There are 2 more meetings this year. They have 2 more opportunities to hike. The market probably could absorb 1 hike without too much of a change. But again, if they signal that the jobs market is still too hot, this kind of inflation print, which reaccelerated a little bit last month, is something that we're so concerned with that we actually think we need 2 hikes in. then I do think that we're in for some volatility on the risk side of things.
Yeah, really interested to see how core and also headline inflation react next month. But we're going to have to leave it there.
Yeah.
Thank you, Marvin Lowe, State
Thank you.
Street Senior Global Macro Strategist. All right, now let's do a quick check of the market sponsored by Tasty Trade. Everything in the red there. We got the Dow down 226 points or 0.2%. S&P 500 down a little bit less than that. And the NASDAQ leading the way south down 113 points or 0.8%. All your market action straight ahead. Stay tuned. You're watching Yahoo Finance.
What story are investors not paying close enough attention to right now?
I think it's water, and we have a real scarcity of water, and it's only going to get worse as temperatures rise. Fresh water, water for industrial projects, water for municipalities, that's going to be a big issue. It's not going to be a big issue this year, potentially, but going forward, I think that's one thing investors need to be paying attention to.
Well, after taking over nearly 5 years ago, CEO of Goldman Sachs, David Solomon is still under the microscope. The board is very supportive of Solomon. That's according to a new note from Wells Fargo banking analysts. And that's despite negative press reports of internal backlash from senior employees. For more on this, Yahoo Finance reporter David Hollerith. So, David, take us through the top few takeaways from this note. I know there was one thing that stood out to me, but tell us what you're seeing.
Yeah, well, I would say the top takeaway is just that Wells Fargo's team had Mike Mayo and his team had met with Goldman's the lead director for their board And that was something that has been waited for some time, is sort of some recognition of public support for Salomon from the board. Now, one issue here is that it sounded like the board was in full support of Salomon, but they hadn't come out publicly. And, part of that has to do with whether or not they wanted to make this into an issue in which the board needed to weigh in the first place. But, through this note, we have one more piece of evidence from Mayo's conversations, at least, that indicate that, Salomon's, despite, having kind of a rough deal-making environment right now, and then also having to deal with the pivot out of consumer lending, that his strategy is supported by the board, and that he will continue to stay in his seat if there was any question of that at the time. So that's the number one takeaway. And then I would say the second most important is just the fact that Mayo underlined the fact that Goldman has had sort of a little bit of whiplash under Salomon, which is how much the bank has had to change. He also pointed out that even though it went public 2 decades ago, that Goldman hasn't really acted as much like a public company until recently under Salomon. And a lot of those changes culturally are pretty rough. That being said, Mayo noted that for the board, the second highest priority is culture for the firm. About 57% of Goldman's employees are new since 2020, which is, pretty staggering to show that there is a cultural shift. And we find this interesting because that's sort of what's happening at the largest banks in terms of their leadership. I mean, Salomon is definitely not the only one who's dealing with a big sort of pivot. I mean, we look at Citi's CEO, Jane Fraser, who's announced this massive reorganization last week, and we're still waiting for more information on that. Morgan Stanley, too, also has their CEO, James Gorman, who should be stepping down within months from his position, even though he'll stay as an executive chair. So, there's a lot of change at the top of the biggest banks. And this is kind of underlining how, culture is such an important part of that. And I think a lot of, the sort of tumult around Goldman recently, outside of much lower earnings than is typical, has been that there's been some partner unrest.
Oh, really interesting. Thank you for that report, Yahoo Finance reporter David Hollerith. In tough economic times like these, everyone's concerned about the state of their wallet. But for Gen Z, those born between 1997 and 2007, more than half are extremely worried about not having enough bucks in a pinch. For more on Gen Z and their finances, Marcy Merriman, Ernst & Young America's Cultural Insights and Customer Strategy Leader, is here. Thank you for joining us today. I found some stats in here pretty interesting, but just give us your big picture overview of Gen Z and the concern over their finances.
Yeah, well, what we're seeing with them is something radically different than what we've seen with past generations at a similar age. And that's important to look at because everyone's feeling different things around finances and money right now. And certainly life stages come into it. But what we look at is Gen Z as these 16 to 26-year-olds today. And in comparison to where millennials were, Gen X were at a similar age. We're seeing a generation with very different attitudes toward money, towards work, towards consumerism, and towards the world in general.
And Marcy, I want to ask you a question, though, especially when you consider, because by some calculations, Gen Z goes even younger, right? So to 2012. So it's interesting to me that they would be concerned about their finances. One positive spin on it could be that the fact that they're even thinking about it as a teenager. So talk to us about how they're viewing the job market for those, especially in the older band of Gen Z.
Yeah, I mean, that's a great point. I mean, the fact that we see teenagers worried about these things, worried about money. I mean, in our research, 36% of the 16 to 26-year-olds we looked at were worried that they weren't saving enough for retirement. So they're thinking about very different things than past generations. And we're seeing that translate as they look into work and they look into what they want. We're seeing a much more pragmatic view. They're thinking about the jobs that they go into. One, what kind of security and safety do they have? They're more interested in understanding the benefits that come with it, what's behind the actual dollars that they see. Another trend that we're seeing that I think is super interesting and we hear a lot about, but I don't think we hear much behind it, is around the multiple streams of income or having multiple jobs. And for them, this is part of hedging their bets.
Well, so let's dig into that a little bit. What kinds of, how deep into the weeds can we go here? How many gigs? And what are the views that are shaping them? Is it just that the American dream, quote unquote, is dead? It's all about the hustle now?
Well, we're seeing in our research, again, 39% of the 16 to 26-year-olds in the US have both a job, whether it's full-time or part-time, and what they consider a side hustle or something that allows them to make additional money. And I really do think this is the new norm. We're seeing it in other generations as well, in older groups. The difference is for Gen Z, this has just been their norm for life. And they're some of the reasons why, one of the reasons why is that they've always had the ability to make money at a much younger age than older generations did. And they don't have to wait till they're 16 to have their work permit to work in a fast food store or a fast food restaurant like I did. You know, they're able to look at selling things online through social media, rather than making and giving away friendship bracelets or selling the friendship bracelets. And we're seeing this translate as they look later in life, looking at every aspect of their life as a way that they can potentially make money off of it. And I do think that there's positive that comes out of this as they think about security, as they think about the implications of what they spend their money on, whether it's college or, you know, a new shirt for the weekend. They're thinking differently about these things, and there's huge implications for organizations, of course, across the board.
It's the TikTok generation. I like that. One of the things I did notice that stood out to me is just the level of anxiety for Gen Z. It seems to be higher than previous generations. And I wonder if your research showed, does it have to do with them living through both the Great Recession followed later by the pandemic? Is that one of the things that came out?
I mean, that certainly contributed to it. We saw this this highlighted or heightened anxiety and stress and concerns about their own stress before the pandemic began. And just like the rest of society, we've seen that accelerate. We've seen it become stronger. But what we also have to think about is this is a group that, one, has lived their life on social media, and that's contributed to how they think about the world and the stress that comes with it. But they've also been hit by the pandemic during a period of time where you're traditionally gaining your independence, where you're, you know, moving out on your own. And that's made it more difficult for them to move into those life stages. And I think that's contributed to the mental health issues as well. But one of the things that we see from them is that they're not being addressed to the degree that they need to. And this is something that they're looking to employers. It's the first time I've seen participants in any survey say they actually want mental health training from organizations, from employers. That's something they value, along with financial training. You know, they're looking for completely different benefits and assets to help them get through life in the way that they feel they need to.
I'll tell you what, Gen Z is about 2 decades ahead of where I was at their age. Another stat that sticks out to me here, and it kind of ties into the previous question, Gen Z is the generation of empathy, 46% saying they were very or extremely worried about the physical or mental health of other people in their lives. Just talk to us about that and how that differs from some of the older generations.
Oh, wow. We could go on forever about that one.
We got a minute.
This is a generation that's worried about other people. You know, they've seen the impact of inequality, of inequity on their friends, on family, on others. And they see the greater role that it plays in society and really pulling us back. And with that, they have more awareness of what's going on with others and the need to stand up for them. The empathy point is an interesting one. That in our research, that's something that's been a little bit unexpected. They don't necessarily grab onto that word. I think the meaning of it and really thinking about what's happening to others is important. But empathy itself, there's some question about it. I mean, I think that goes along with their level of distrust. 67% say people can't be trusted. So when people talk about empathy or being empathetic, I think there's some skepticism behind it, wondering whether it's real, whether it's something that's really important to them and they're doing something about, or if it's marketing buzz or something on the surface. That goes for people and organizations. So I think that we have to watch how we approach things and actually show that we're walking the talk behind the words that we share.
All right, we will have to leave it there. There were a lot of good things that stood out to me, especially another thing that stood out to me was the trust factor when it comes to businesses. Yes. So yeah, that really stood out to me. All right, Marcy Merriman, Ernst & Young, America's Cultural Insights Customer Strategy Leader. We appreciate you for joining us today.
Thank you.
Got it. All your markets action ahead. Stay tuned. You are watching Yahoo Finance.
You have tons of great economic analysis, markets analysis as well, but you're also training for the New York Marathon. What is your number one tip for all the runners out there that are perhaps trying to get their miles in and see you when they're running throughout the 5 boroughs here in New York later?
Yeah. Well, first of all, you have to be really determined to do it. Do not give up, because as much as it can be very painful and exhausting, when you get through that, you feel great. So just keep going. And keep training with consistency. You can't slack off, so to speak. You got to do it every other day, I would say, or every 2 days, and really put in the work. You'll make it.
The strike against the big three automakers enters its 5th day, with the deal still elusive. The UAW warning over more action if, quote, serious progress is not made. Union reps say they received no new offers from GM, Ford, or Stellantis since it laid out its proposals on September 14th. Stellantis says it has resumed negotiations, however, citing constructive discussions. On Friday, 9% of the union's nearly 150,000 members, they downed their tools. And joining us now with her take on what sets these strikes apart is Erica Groshen, Cornell University School of Industrial and Labor Relations Senior Economic Advisor. Erica, thank you for joining us today. What do you make of the latest here?
Well, in some ways, it's not terribly surprising. We certainly have a very strong labor market, a very strong economy, and strike activity usually rises when the economy and the labor market are strong. So we have the immediate conditions. And then we are in a time of technological change, say for entertainment professionals, the growth of generative AI. For auto workers, we're talking about the move to electric vehicles and robotics. So that's at play. And the administration is more friendly to organized labor. That helps. So we have a lot of things that suggest that we're going to have labor market activity, and that they're probably behind a lot of what we're seeing.
So, Erica, we saw a summer of strikes, and basically this is heading over into the fall now with a lot of different kind of sectors of the economy. Now UAW threatening that their strike could expand on Friday if, there's not more serious progress, quote, made. What is the expectation for the impact to the economy from your view, especially if these strikes continue to extend out?
Well, so I mean, as an economist, I always say on the one hand, on the other hand, right? So here we go. I mean, this actually could be good if it ushers in an economic period like we had during the 1960s when unionism was more widespread and there was more activism. But this was a period with very high productivity growth, improved living standards for all workers, less inequality than we see now. So it could be turning a corner to get back to some of the salient features that we've had before. On the other hand, of course, it could be bad if we see labor strife without creative cooperative solutions to workplace issues, which of course include pay and benefits, but also training, working conditions, worker voice like that. And then there's always a possibility that's neutral. This is just a flash in the pan, and we go back to the trends that we were on for a long time. So I think the jury's still out, but there is potential for this to actually be a force for creativity and cooperative solutions going forward.
And how do we foster that? How do we engender that, given the sides, everybody seems to be at odds here, and also the state of the economy kind of plays to this as well. We've seen a high number of strikes recently. These things tend to happen when times are good. Maybe talk to us about the state of the economy and how that influences these discussions.
Well, workers see that corporate profits are high, particularly in the industries they're looking at, so that they understand that they're not going to be driving their employers out of business, right? That this is more about sharing the pie. All right, so that, that contributes. Workers knowing that they have alternatives in the labor market, that if they leave this job, that they can probably find something else is important. So those things play into the calculus behind, a rational calculus on the part of workers to decide whether they want to be more active. Unionization in the U.S. is still on the decline, so we haven't seen an increase in unionization. What we've seen, and it's really only since July, is this big increase in work days idled because of strikes. And we do have a slight increase in the number of strikes, but it's mostly long strikes. So the workers are feeling empowered and willing to stay out long enough to get the kinds of deals that they think they deserve.
And Eric, I want to ask you one just kind of final thought that it's something that we haven't given much thought, or we haven't had conversation about this, you and us. Just the prospect of AI and the threat that could mean for union workers. Is that a concern that you've seen in your research, and kind of a looming factor over this particular striking sector, the UAW?
Well, I'd say that the implications of AI are perhaps clearer for the entertainment workers than for the UAW workers, although I'm not close enough to know if there's some issues there with them as well. But it comes down to this idea of are the workers at the table when the companies make their choices on how they're going to implement changes, right? Or are these decisions being made far away from the workers without any input from the people who are closest to the shop floor and really understand the processes involved? So in other countries, say Germany, there are mechanisms in place in all of these companies for that voice. And in a lot of American workplaces, there are no such mechanisms. And so that stokes fear on the part of workers that their interests, their capabilities are not going to be considered. And so more of an interest in making sure that there's a vehicle.
Yeah. All right. Erica Grosjean, we'll have to leave it there. Thank you so much for joining us of Cornell University School of Industrial and Labor Relations. We appreciate you.
My pleasure. Thank you, Diane. Jared. Have a good day.
You too. And we're awaiting the IPO of Instacart. The latest indication says $41.50. That is the potential opening print after IPOing its shares, selling them at $30 per share yesterday, Diane.
Yeah, I mean, it's expected to be a hot public debut, and it's expected to have a hot day today, and especially when you see where it stands now, whereas previously the indication was lower than this. So
and I think they left it at $30 last night because they wanted some money on the table, very similar to that ARM deal we saw last week.
Right, exactly. But to your point about ARM, that's a bigger,
much
has
bigger.
Exactly. I love the boxing ring analogy that Josh had out there. So it'll be interesting to watch this one, not just for the day. Obviously, it'll certainly do well. But one, what will the retail demand look like? Especially, we saw some retail demand for the ARM IPO, right? But then where does it go after this, right? Can it keep up the hype? Right.
Yeah, well, the revenues have flatlined over the last year, so that's a big problem. You don't want to see that, something that's just coming into the market as a growth company.
Yeah, indeed. All right, we'll be watching that, and we'll certainly break that as soon as the opening trade happens. Meantime, the number of U.S. firms optimistic about China's business outlook over the next 5 years fell to 52%, a record low, according to a survey from AmCham Shanghai. Political tensions between China and the U.S., alongside China's slow recovery, were top concerns for leaders. With more is Yahoo Finance's own Rick Newman. Rick, hi.
Hey guys, I think this undermines a lot that we've been seeing in the relationship between the United States and China. And it's not just the Biden administration. I mean, let's remember President Trump first imposed tariffs on about half of all Chinese imports to the United States back in 2018. China retaliated with imports on U.S. exports from the United States to China. And those tariffs are still there. Meanwhile, China has had a difficult time getting out of the COVID hole. The economy is underperforming. They've got huge problems with debt in the real estate sector, which is a giant part of the economy there. So China is just not the jewel of the global economy that it once was. Now, in this same survey, there was some evidence that these business leaders say their companies are now emphasizing investment in other parts of the world, mostly in other Asian countries, and that reminds us of some of the things we've seen recently, such as some exports that are coming into the United States now coming from places like Vietnam or Singapore. I mean, you've had companies, some of those are even Chinese products, but they're going through third-party countries. So there's a lot going on in the relationship between China and the United States. I would say this idea of complete decoupling, though, we do not have complete decoupling. We still have tons of imports coming to the United States from China. A lot of that stuff you buy on Amazon still comes from China. I think we're just seeing changes in some of the ways that the whole relationship is being organized.
Yes, definitely no decoupling that is imminent. They're going to use our stuff, we're going to use theirs, and we are kind of joined in the hip in a few ways. All right, thank you for that, Rick Newman. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Best piece of career advice that you've ever got?
Ask questions and sometimes wait to answer when you're asked questions.
Crude oil screaming higher to 10-month highs as gold and metals perk up. Meanwhile, traders are trying to figure out the dollar's next move. Here to help chart it all and break down the technicals is Michelle Schneider, Market Gauge partner. Mish, always great to see you here. I want to direct everybody's attention to the Wi-Fi Interactive. I'm going to be running some charts for you. I'm starting out with crude. This is WTI. Over the last 3 months, up 31%. And then when I change to a 1 year, you can really see the consolidation that it just escaped from. So how high does it go?
Well, people are talking about the big breakout over 90. And just as that line you drew showed that really 80 to 82 was the bigger area, considering the consolidation. So if you just want to go old fashioned charting and take the measure from the low to where the breakout is, you're looking at about a $20 move from there. So that puts us at around 102, 103. And that's purely technical. From a more fundamental standpoint, of course, this is a move based on low production, OPEC cuts, et cetera. Obviously, our strategic reserves being low here. And we're seeing this great rise on also the anticipation that demand will stay high. And of course, we're going seasonally now into a bit of a different type of demand where we're not going to be so much in the driving season now as we get into the fall. So I'm looking at it more like, can it go to 100? Can it go higher? Absolutely. I know commodities, right? They can be very emotional and they can go parabolic. But this has been kind of a very disciplined run up, if you will. So I'm not so sure how much higher it's going to go, but I definitely think as long as it holds 90, it's more upside than downside.
And Mish, I want to ask you about another sector where we can kind of sometimes see these strong swings, but lately it hasn't been as much. What do the charts tell you about the direction of small caps, especially when we head into the remainder of the year, the last few months of the year?
Well, it's so curious, and it's a great question, Diane, because they are very much tied to a few areas. Obviously, the retail sector, which would be looking at it through XRT, has been extremely weak, while the small caps have held up relatively well. And now we're seeing, especially today, it being stretched down closer to the big breakout it had if we just look at the Russell 2000 over 1800. So what's going to really happen now is whether or not we can hold that 1800 level. And particularly if the retail continues its decline, what happens if that goes down a little bit further? So small caps are actually outperforming just on a relative basis today. But what we're really seeing, I think, is after our oil conversation, is a potential pressure in the whole U.S. economy, even though we're hearing how strong it is about the soft landing, with the Fed on tap, what they're going to do, and how much can current rates hold up the inflation, which clearly we're seeing pockets besides oil starting to rise.
Mish, I know you're looking at XRT, that's a retail ETF, IYT as well, and then junk bonds. Just give us some idea, call out takers, and we want to know, I'll put visually what you're saying, or at least I'll try to.
Well, we're now talking about three members of my economic modern family, Jared, right? So we had Grandpa is the Russell 2000 because it really represents the 2,000 small cap stocks within the United States. So it's very US centric, which is why it's so important for it to hold up. And very often it lags behind growth, especially over the last decade. But at some point, it can become an anchor. And of course, Grandma, which is the retail sector, really represents the other side of the demand of the U.S. economy because of consumers. And we've seen all of these big box stores, really, except for Walmart and Costco, having huge struggles and going down. And then transportation, obviously the strike would have some impact on it, but not too much. That also is reflecting now how demand is going down. And even though we've seen much lower prices in airfares coming into now, I think obviously we'll see airfares starting to go back up with oil prices. So all of this is not really saying disaster, but it's saying weakness and caution, especially if we're looking at these charts that are now breaking down under key moving averages, looking at XRT and IYT. Is the small caps next? And then what does that mean?
So what does that mean? Like, what do the charts tell you, especially when you look at the fixed income? And, I know there's been strength in the dollar. Are you expecting to see that bullish kind of trend continue?
Well, as far as the dollars, I think obviously it's gotten up to where it is, but it's having a lot of trouble getting through 106. It's actually topping out here. So there's other pressures on the dollar as well. And so right now I'm anticipating that we could see 104 before we see 106. I mean, that's just a guess at this point. We're smack dab in the middle of 105. And if you just took the opinion out and looked at the chart, it certainly looks like it may be consolidating to go higher. The dollar to me isn't as big a factor. We're talking about risk, right? And junk bonds, you had asked me about that before. Mm-hmm. That's a really important indicator to look at for risk. Coming into today, we want to see junk bonds outperforming the long bonds, and we look at that through the TLT. And so far, they are. So if we're looking at HYG, for example, you want to see it holding around these levels. Actually, the level is 74.50. There's a trend line there from the lows. It's now under the moving averages, but it's been relatively risk on. If that changes, then I think we'll see the whole market, given everything we just talked about, and the dollar may actually wind up rising in that scenario, go lower. This 440 level in the SPY, or 4,400, if you will, could easily lead to 4,200.
Yeah, I love watching junk bonds as an indicator, potential bellwether there, as I know you do. Thank you for everything here, Michelle Schneider, Chief Strategist at MarketGauge.com. All your markets is straight ahead. Stay tuned. You're watching Yahoo Finance.
Make sense out of what's happening in China for us, and are we getting any more clarity that we need on the markets front?
So China is stimulating its economy. A lot of people think they're not, but they clearly are doing it. But it takes time, and I think that China is not in the policy that we did, like a big reopening and trying to stimulate it through free checks and say, let's go and spend a lot of money. Chinese consumers are different. They're also very cautious because what happened during extensive lockdowns, they're wary. But there is some change, and I think that this is about China being very gradual in its approach, knowing it can reach its goal for 5.5% growth. It may not happen this year, however, it may be something for next year.
We are watching and awaiting the IPO of Instacart. You can see on your screen, $42 a share is what is indicated, but we have yet to see it open yet here. And Diane, we've been talking about Instacart all morning, and something interesting. You know, I mentioned the kind of flatlining of their orders from the first half of this year compared to last year. Not what you want to see in a startup, but they've had a different kind of mix there. They've gotten into advertising under their newer CEO.
They have to.
And he comes from Facebook, and so not surprisingly, they're a bit more profitable now. Just kind of add something to the mix.
Yeah, I mean, look, they have to diversify, especially when you think about where they've come from and what their valuation was at its peak. I mean, at one time during the height of kind of the Instacart craze during the pandemic, the valuation was south of 30 billion. I mean, nearly 40 billion, right? So it's a far cry from that valuation level, even though the indications are above the IPO price where they priced last night, right? So certainly the demand for their public debut is there today, but again, not as high flying as it once was. So we'll see how this, you know, kind of fervor carries past the first day, right? One, will there be retail interests like we've seen in a couple other, you know, recent public debuts? Two, also when you think about kind of the IPO pipeline, what this will tell for the IPO pipeline and other public debuts that we'll be watching through the end of the year. But
no rush to get into any of these. ARM already undercut its IPO day. So well, we'll see. We'll have to wait there.
That's right. All right, we'll leave it there for now. I'm Diane King Hall with Jared Blickery. Thank you for watching. Keep it locked here on Yahoo Finance.